That's like China-like numbers coming out of the United States. So we are watching inflation carefully, but what's more driven by this underlying demand and the snapback and the output gap, more employment. So, you know, this grinds higher for now.
What's a single point yield, Joe Quinlan, on 10-year yield where you begin to say inflation? What's your level that matters?
Above 2%, Tom. I mean, when we get like 2.5, you know, and as you said, it's the velocity, how fast we get there. So I don't think we're, you know, we've got a year-end forecast of 175. Maybe we get there a lot sooner rather than later. We break through it. It's how fast we get there and how disorderly or orderly.
And John, you've got to fold in here the vector of hospitalizations on vaccines. And if we are wrong about the reemployment of America and it happens faster than anybody thinks, that folds right into this calculus.
Well, cases are plunging, Tom. Cases are plunging in the United States. And Lisa, the news out of Israel, really positive over the weekend as well, that the vaccinations, and they thought maybe the vaccinations didn't stop the spread. Well, guess what? It looks like it does in a big, big way.
Well, and that actually, to me, was the biggest takeaway, this idea that, yes, if you get vaccinated, Tom Keene, you indeed do get protection, and it does change the way you can operate in this world and potentially gets us closer to herd immunity. Joe Quinlan, there is a question here about whether this is a viable dip, given the fact that we're seeing fundamental shifts in the economy, that we're potentially going to be getting this $1.9 trillion stimulus, that the world is going to be potentially reopening earlier than expected, which raises a question. Is buy the dip not the policy you can follow with the large cap stocks at this point, given the fact that this inflationary push may be real?
Well, I would still buy the dips. I mean, if we get a pullback here, a pause, for sure, we'd be buying the large cap stocks. They're going to do better, U.S. large cap stocks, as Europe. You know, Europe's about 2 or 3 months behind us in terms of opening up, but they'll come back to service side of the economy. China's looking better, Japan. So, yes, we're buying. Any pullback here is a buying opportunity based on all the stimulus, pent-up demand, CapEx, households, you name it.
Joe, I want to pick up on some consensus trades, commodities driving higher. EM equities have had a really nice start to the year as well. And underpinning both of those stories is the idea we have a weaker dollar, or a dollar that stays where it is right now, with a huge short position around the US dollar coming into 21. I'm looking at real yields starting to break out a little bit here, Joe. Kit Juice's SocGen asking a question this morning, whether that is a challenge to dollar bears. Do you think it is?
Yeah. I think the weaker dollar story is oversold. I'd be careful. I think the dollar's got a stronger bid than most people realize because of the growth dynamics that are coming forward, earnings, and the competitiveness of U.S. companies. I wouldn't be betting too much against the dollar.
You know, and John, this is really important. First, 2 things. The first deflation talk of this week for us was at 607.08. I just want to make clear here.
Didn't take long, did it?
Didn't take long. We had good deflation talk at 607.08. And the other thing, John, I'd point out is the most important thing is to reassess earnings and revenue expectations of corporations. It's a total mystery out there into August and September.
Well, here's the good news already. And Joe, weigh in, please. The good news already is that we've already seen positive year-on-year earnings and revenue growth for S&P 500 companies. Did that come earlier than you expected, Joe?
Not necessarily, John. I mean, like we went into the year expecting stronger than expected GDP growth, stronger than expected earnings growth, and here we are. Do we think that's going to continue? Yes, into the second quarter. But then the markets are going to start looking to 22, and things get a little softer. There's more of a headwind when it comes to normalization of the yield curve, and so you know the big stimulus kind of wears off into 22. So, but yes, the markets are pricing in better than expected GDP and earnings growth for now.
And so far, they've been right, too. Joe, it's great to catch up, sir. Joe Quinlan, Maryland Bank of America Private Bank, head of CIO Market Strategy. Your equity market now down by 0.7%, off by 27 points. Joe mentioned 2021, and I think it's important to go back to that Ellen Zentner call over at Morgan Stanley, Tom. It wasn't just about the upgrade to 20. It was about the upgrade to 21. The idea that that growth boom can last a little bit more than just this year alone.
Yeah, the idea of, you know, go back to March of a year ago. I mean, we're coming up here on a one-year rotation.
Yeah.
That bridge out to where, you wonder where the bridge out to where is going to be on the better vaccine news. I looked at the research this weekend, John. I thought it was extraordinary. Stephen Major over at HSBC publishing on West Ham. I thought it was a really intelligent note.
Steve messaged me just before this show started, and it just had the Premier League table, and then it said the real story. And for people who aren't aware, Steve Major of HSBC, massive West Ham fan, 4th in the table now. Champions League spot maybe, Tom. away from your tots.
You know, my issue here, John, and I brought a tear to my eye. I'm looking at relegation at Tottenham. I mean, I don't know if it can happen. You understand that better than me. But you go back to '76 where they were relegated behind Coventry City. I mean, that was outrageous.
I would like to offer up Stephen Major an apology and everybody else perhaps you can thank me later. But we were going to open the show with that, and I decided to argue vociferously against it. But Tom, I do want to raise one question. You're making fun of me with deflation talk. I want to clarify that.
Please.
Disinflation is the concern that some people have. Stagflation, the idea that you have inflation that picks up because of the M2 supply, the monetary supply that you're talking about. You don't necessarily have the commensurate growth. And Mervyn King, formerly of the House of Lords in the United Kingdom, had an op-ed today in Bloomberg Opinion talking about how we're not investing enough in the actual, fundamentals of the companies.
That's exactly what Lawrence Summers said in the video we had of Krugman, Summers, and Stiglitz. He said exactly the same thing. Where is the incentive to invest? And to me, it's simple. Go back to the 60s. It's tax credits. Motivate them to invest.
Well, and this raises a question, John. At a certain point, do we start to care about stagflation, the idea that inflation of goods and services goes up, but wages, not so much?
Stagflation, Lisa. What is going on?
John, it's so... help me, John.
I'm just saying, this is a real concern.
Lisa, I appreciate that concern this morning. Thank you. Lisa Abramowitz alongside Tom Keene. I'm Jonathan Ferro. It has been confirmed. It's Monday morning. Futures are down 27 on the S&P. We're off by 0.7% on the S&P 500. From New York, this is Bloomberg Surveillance.
With the First Word News, I'm Karina Mitchell. A study from Israel shows that the Pfizer-BioNTech vaccine appears to stop the vast majority of recipients in Israel from becoming infected. It's the first real-world indication that immunization can stop the spread of the coronavirus. A draft of the study says the vaccine is 89% effective. Some scientists are disputing its accuracy. Meanwhile, in the UK today, Prime Minister Boris Johnson will announce all schools in England will reopen starting March 8th. Johnson will be in Parliament outlining how the virus lockdown will be lifted over the next few months. More social contact will be allowed from March 29. That includes outdoor gatherings of either 6 people or 2 households. And airlines in the U.S., Japan, and South Korea have grounded Boeing 777s following that explosive engine failure over the weekend. United Airlines Flight 328 made an emergency landing in Denver after one of its Pratt & Whitney engines suffered a fan blade failure. Engine parts rained down on a Denver suburb. Meanwhile, China is urging the Biden administration to scrap tariffs and restore goodwill. The Chinese foreign minister says the two sides should reopen dialogue that was cut off under former President Trump. He reiterated the need to remove what he calls unreasonable tariffs. He also cited curbs on Chinese media and students as other areas of concern. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. There is much more to come. Stay with us. This is Bloomberg.
nuestro país, igual que los demás países del mundo, no está preparado para esta pandemia. Más aún, los más afectados son los países de desarrollo como el nuestro, ¿no?
Women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg Television, alongside Tom Keene and Lisa Bramwitz. I'm Jonathan Ferro. Here's the Monday morning price action for you. Good morning to you all. Equity futures pull lower. We're down 28, call it 29, and off by 0.75%. The why? You'll find the why in the bond market. Yields breaking out, real yields breaking out. Yields 136.70 on a US 10-year. In the FX market, euro dollar, just a little bit of euro strength in the mix. The mix seen in G10, euro dollar 120, 131. Crude up by 0.8%, call it 0.75%. Tom Keene, elsewhere, copper absolutely flying through 9K.
Yeah, that's on fundamentals as well. I mean, I notice a Bloomberg commodity index breaking out as well. I do want to point out the VIX out two big figures, 24.08. Not a good number yet, but nevertheless, there it is. On Washington, on what it means for you and global Wall Street, Emily Wilkins joins now at Bloomberg Government. Emily, the stimulus today, what are you and Kevin Cirilli going to watch for? Like, in the blur of the marble halls, what's the stimulus thing that's of interest today?
So the big question, this is a huge test for Democrats, right? It's the first time that they are trying to pass a bill. They only need Democrats to vote for it. But can they get all the Democrats on board? There's a lot of consensus around this bill, but there's also a lot of debate, particularly around the $15 minimum wage. And we're looking at that in the House, and then later this week, particularly when it goes to the Senate, is where that could hit some real sort of rough terrain.
Over the weekend, for those eating caviar or, Big Mac meals or whatever, people not focused on the market, Emily Wilkins, near at hand and really at risk here to be part of the Biden administration. Is that the beginning of the power of the moderates, and will we see that kind of power in the stimulus debate?
I mean, definitely Neera Tanden was on track to be OMB director until Democrat Joe Manchin kind of came out and said that he would not be supporting her. And at this point, yeah, it doesn't look like there are going to be any Republicans supporting her either. So yes, her nomination is very much in jeopardy right now. And yes, this is the first time that we've really seen Manchin come forward, sort of flex his muscle against Democrats and President Biden. And so, yeah, there are definitely going to be other opportunities in the future for him to do that, although he has indicated that he does want to see the stimulus passed. He is supportive of President Biden's efforts to really help the American people at this point.
A little bit later today, Emily, we will hear from the Prime Minister Boris Johnson in the UK outlining plans to get back to normal, to reopen, because things are progressing so well. Do you feel a similar pressure building on the president to do the same thing and do it soon?
I mean, if you just look at what President Biden has said in regards to schools opening, you can definitely see that there's some pressure there. Just the other week, we were hearing from them that their metric of success was to have 50% of schools open 1 day a week. Now they're coming back and saying that they want all K-8 schools open 5 days a week by the end of April. So there's definitely a significant amount of pressure that seems to be on the Biden administration to encourage schools to reopen, even if teachers aren't given their vaccinations yet.
April is a month that I think echoed around a lot of people's conversations over the weekend. Lisa, April. Dr. McCarkey at Johns Hopkins University, writing in the Wall Street Journal through the weekend in an op-ed piece, and the following line got everyone's attention. At the current trajectory, I expect COVID will be mostly gone by April, allowing Americans to resume normal life.
Well, and I think that study out of Israel really edified that view, this idea that if you got the prevention of transmission from non-symptomatic individuals who've gotten inoculated, that's a game changer. Emily, given that there potentially is a game changer sooner than later, how much pressure is there on Democrats to ratchet back perhaps aspects of this bill in order to get an infrastructure bill through later in the year that could stimulate further growth that could have longer lasting consequences?
Well, at this point, I mean, Democrats have already sort of done the work to compile this $1.9 trillion stimulus package. And at this point, they'd just be wasting time to go back and try and make more major changes to it. So it looks like we are going ahead with this stimulus. We're expecting to see Fed Chair Jerome Powell talk to lawmakers this week about the importance of having that stimulus, how even though things are looking good, that unemployment is still high and there's still room in the economy for this amount to come and actually do good rather than negative.
But Emily, let's say they do get their bill passed within the next 3 weeks. This does go to a key question and tension in markets. Is there the political will in Washington, D.C. to get a further bill done on something more sort of structural in nature, whether it's infrastructure or whether it's something else? And right now, it doesn't sound like there is if there's so much internecine debate among Democrats themselves and if Republicans aren't on board. Am I wrong?
Well, Lisa, I think that right now everyone's kind of focused on this stimulus bill, but you're absolutely right. President Biden, Biden administration, lawmakers are beginning to talk about what a larger infrastructure package would look like to come after the COVID package. And I think at this point, we're sort of in the very preliminary stages, and it's hard to know exactly where the fault lines are going to be here. But look, Democrats, they have a couple opportunities to pass things with only Democratic votes without having to get Republicans on board. The stimulus is one opportunity, but they've still got another opportunity, and I don't think any Democrat here in Washington wants to waste that chance.
Emily, what will we see as we think of 500,000 deaths? I mean, what is the actual agenda today for Washington to try to understand the scope and scale of 500,000 deaths?
It's a difficult number to comprehend. Americans have been asked to comprehend so many large numbers in the last year of death and what it looks like. We are going to be seeing President Biden today commemorate, sort of hitting that mark, remembering those Americans who have lost their lives. I expect that we're also going to see a lot of lawmakers using this occasion to sort of continue to press the need for a stimulus bill, for a bill that's going to get funding out there for vaccines and for helping individuals, kind of saying, look, this isn't over yet, even though there might be good signs on the horizon.
Emily, thank you. Always appreciate your time. Emily Wilkins there down in Washington, D.C. It's a dark moment, Tom, and that number doesn't even capture how dark things have been in the last 12 months.
Yeah, I just looked at the log chart. This is where slope matters, folks, of the deaths in the United States of America from this pandemic. And the good news is I've got exactly 2 and only 2 data points that tell me maybe it's over, maybe it's flat, maybe it will get better. John, right now, I can't say the trend is going to stop and we need to start thinking about 600,000 deaths, but I'll tell you, you get 3, 4, 5, 6 more data points, and then you really have to reassess towards optimism.
Yeah, and I think at this point, Tom, Lisa, I think we can conclude things are getting a whole lot better and quite quickly.
Well, and this is the reason why reflation trades are getting so much steam right now, this idea that if we end the pandemic sooner and we still have this incredible amount of fiscal spending and an additional follow-on that will turbocharge the market, which is the reason why people are saying this time may be different when it comes to inflation.
Okay, so here's the question for the market. Global risk rally, Tom, or dispersion? Do we start to see some real dispersion amongst economies, between economies?
That's in some of the research papers. And you see, you know, as Bill Gross used to say, the locomotive for the global economy, or does it disperse away? And again, I'm going to go back to Asia and to that strange thing, John, we used to talk about, which is world trade and global trade. And, you know, it's just simply, will we see that?
Much more still to come on that. Coming up on the program, Dana Ramoa, JP Morgan Asset Management Senior Fixed Income Portfolio Manager. Looking forward to that conversation. A beautiful New York City this morning, this Monday morning. Equity futures down 26 on the S&P 500, off by 0.7%. The story getting everybody's attention is in the bond market. Yields up 3 basis points to 136.36. We keep climbing with futures lower, bond yields breaking out. More still to come for our audience worldwide, seen on Bloomberg Television. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro, counting you down to a ton of Fed speak this week. Chairman Powell tomorrow, Vice Chair Clarida, Governor Brainerd. What do they think about what we've seen in this bond market? This is Bloomberg. New York City. This is Bloomberg Surveillance for our audience worldwide. Coming into Monday, 4-day losing streak, a weekly loss. Looking at the market right now, we're about to add to it. We're down about 0.5%, 0.7% on the equity market. This is the wrong board. This is the bond market year to date. There's the right board. Nasdaq futures coming in more than 1 percentage point. Why? Tech stocks getting hammered because real yields are breaking out. Let's look at the nominals, 2s, 10s, 30s on the session. Switch up the board, please. On a 2-year, on a 10-year, on a 30-year. There we go. Up about 3 basis points on 10s to 136.36. On 30s, now 216. Yields higher by 2 basis points. Huge fiscal stimulus plan coming in the United States of America. Switch up the board and get to this. Year to date, the moves. I'll show you some countries where there is not a $1.9 trillion fiscal stimulus plan coming. Germany, Australia. Look at these moves year to date. Australia out by 63 basis points to 160. The Aussie absolutely flying, even with Governor Lowe of the RBA flirting with the idea of not raising interest rates until 2024. In Germany, yields up on the year by about 26 basis points to negative 31 basis points. They also do not have a $1.9 trillion fiscal stimulus plan coming. So look out for the central bank speak today, not from the Fed, from Christine Lagarde of the ECB a little bit later this morning. Eric Nielsen of UniCredit talking about this, Tom, and I think it's really important. Elsewhere, as Treasury yields start to drag everyone else with them, are we seeing an unwarranted tightening of financial conditions a little bit too early for the liking of some of these central bankers?
Watching in foreign exchange as well. Again, Euro Swiss is showing weak Swissy, really original back a couple of years right now. Timely, Diana Moll with us with JP Morgan Asset Management with a real focus on emerging markets. She joins us this morning. Diana, I want to look in your research notes at the distinctions involved. You can't buy EM blind. You can't buy big developed countries blind either. What are the distinctions right now of placing capital in emerging markets?
So right now, the big driver, and we're seeing that playing out as well in developed markets, is actually growth. The vaccine rollout has been a very big focus on the markets, and I think there is growing confidence now as the pace accelerates, as you have more vaccine candidates coming into play, that this is going to be done in a sustained manner. And in some cases, we might even see reopenings of the economies as early as Q2, full reopenings in places like the US, the UK, markets like Israel, where they're far advanced on the curve. So in emerging markets, very similar stories are playing out. The focus has very much been on focusing on those economies where a rollout of vaccine has been credible and is actually well anchored. So you look at somewhere like Chile. Chile stands out amongst the LATAM and actually amongst broader emerging markets as being one that's really ahead of the curve in rolling out vaccines, and that's actually traded well. Right. Similar story with Turkey.
So, Diane, I know you're a great student of this. What's so important here is the maturity, the maturation, rather, of emerging market bonds, the size, the scope, the scale. Do the commodity EM nations have a greater, more sophisticated bond pool to play with?
So by and large, commodity exporters tend to have more issuance. They're larger economies, so that's not unexpected. But then, so that side of things is actually a positive for them in that liquidity is not necessarily an issue. But actually, where we're seeing interesting opportunities right now is in the smaller idiosyncratic stories within emerging markets. Those are markets that have less beta to what's happening in core rates and are less likely to be impacted by the big duration move that we're seeing in the US.
Diana, so much of the emerging markets call has hinged on the weaker dollar consensus. And here we have a growing number of naysayers who argue that you have American exceptionalism, that basically you have an economy that's going to break away and accelerate at a faster clip because of the vaccination schedule and because of the fiscal support and stimulus that the Congress is passing. How much does that disrupt your thesis, disrupt your argument that you need to go into emerging markets debt in order to get any yield?
So far what we've seen this year is most markets have actually, from a total return perspective, most markets have been dragged higher in yields as treasuries have moved. However, spreads have held up quite well in EM. And the big distinction up until now has been the move higher has been led by break-evens. What we saw last week is somewhat concerning for the outlook going forward, where it's no longer a break-even led repricing of rates that we're seeing in the US. It's actually being led by real rates. And that's actually something that we think the Fed is likely to be more sensitive to, because not only are we seeing that spilling over to EM, we're also seeing that impacting US markets. So you see mortgage rates are starting to rise. We had the biggest rise in US mortgage rates that we've seen since August last year. While the economy is looking promising, the recovery is still at the early stages and it's still quite fragile. So we do think the Fed is going to want to lean against this.
Wait, hold on a second, Diana. This is important. Are you saying that a key component of your emerging markets call is a belief and faith in the Federal Reserve to come in, buy more longer duration bonds to suppress yields if you start seeing real yields continue to rise?
No, that's not what I'm saying at all. What I'm saying is if it's rates moving higher because growth is picking up globally, and it's an orderly repricing higher of rates, both real rates and break-evens, that's a good environment for EM because growth is what matters and exports from emerging markets are a key driver of returns. However, if we see rates markets running ahead of what we're seeing in the data, then that becomes a concern. And I think right now where we are, the data is not there. Markets are pricing in a stimulus that hasn't yet been approved. So that's the big distinction. We actually need to see that growth being realized, and we need to see that inflation being realized. And that's something the Fed has been quite key in reiterating time and again, that it's actually realized core PCE that they're focused on.
Dana, let's sit on the Fed just for a moment then. Chairman Powell tomorrow, Vice Chair Clarida in the mix as well. If there is some kind of intervention, it's usually verbal first. Do you expect any actual real action off the back of that?
It's probably too early for them to do anything more. So I think they'll want to sequence the tools that they use to talk to markets and to communicate with markets. So this week we have a raft of speakers coming in, starting with today where we'll see the first speaker and tomorrow where we have Jerome Powell speaking. I think verbal intervention is going to be key. We already had Jerome Powell speaking in previous weeks, reiterating the messages. So it'll be key to see them doubling down on that message, that while the outlook is looking better, the economy is far from at a strong enough footing for them to be easing back on accommodation. And I think if markets still continue to price in or accelerate too fast, then it's likely that we might see more tools coming to play.
Tom, this is the issue at the moment, isn't it? A couple of weeks ago, if you'd asked me about Chairman Powell, I would have said they'll stay on script, nothing new. Looking at the move that we've seen in the last week alone, it was a struggle to break 120 for about a minute. And then we got through 120, through 130, and now people talking 140, 150 in the very near-term future.
I haven't done the technical work above a 1.36, but John, I'll make it clear the one person I'm watching in the Speakathon this week is Richard Clarida, head of Columbia Economics, truly one of our great academics on monetary theory. If there's one person who's going to say one sentence, it's going to be Richard Clarida.
He has provided the guidance for financial markets, that's for sure, over the last couple of years, as maybe Chairman Powell has fumbled things just a little bit. Diana, do you have a number in mind where we get to on a nominal yield on a 10-year that starts to infect risk assets elsewhere? If it's not 136 and we're seeing equities gap lower now, is there something a little bit higher, or are we there?
So I think the technical chartists have been flagging 138 as a key level. And it's not surprising that as we approach that, we're starting to see a bit of a spillover into other financial assets, which the Fed will be watching closely. But I think 150 is also another one to watch, because that's the point where the 10-year yield is equivalent to the S&P dividend yield. And so for people who've been saying, why would I want to buy fixed income when the yield I'm getting from equities is much higher, then it becomes a different conversation where fixed income is actually yielding enough and still providing you the ballast in the extent that we see any growth drawdowns coming forward to be meaningful in a portfolio again. So I think 150 is going to be the next level that we're watching very closely.
Diana, I'm sitting here and I'm thinking about what you have been saying, and I'm struggling with one aspect, the idea, yes, the data has not been showing the growth that perhaps markets are pricing in, but markets are forward-looking, and they are looking to the reopening of the economy and the expectation of the stimulus being passed. What if the Fed is wrong? What if the Fed buys a whole host of longer duration bonds and allows risk assets to keep going up, and that reflation that everyone is talking about comes back online and that growth? I mean, does that increase the chances that the Fed will have to hike much more rapidly on the back end?
So for the Fed to change their conversations around when they'll start hiking, you need to see inflation coming in and staying elevated for a sustained period. We already got guidance previously from Clarida that a sustained period means 12 months. So it's very difficult for me to see the Fed in the next 12 months starting to hike rates. They might signal that they will be rolling back on some of their purchases before that. We'd expected that to happen in Q4 as early as September. But if the economic data looks promising, they might start preparing the markets for that move. But in terms of hiking, I think we need to see realized inflation above target for a sustained period of time. And that's really not yet where we are.
Diana, always great to catch up with you. Thank you for your time. Diana Rameau there of JP Morgan Asset Management. Thank you, Diana. Good to see you.
Thank you.
And Tom, this is the issue around inflation. It's got to be driven by a much tighter labour market. An output gap that closes aggressively and quickly may get it done. Yeah. But looking where the labour market is right now, Tom, I think in the view of most people on the Fed, there is still a ton of work to do.
Well, there is. I mean, come on, there's 9-10 million. Heidi Shierholz will extrapolate out to 12 million. But there are labor indicators getting us back to February levels. I saw one chart this weekend, I'm sorry folks, I can't tell you where, showing manufacturing employment really getting nicely back to pre-pandemic levels. And you get 4, 5, 6 sectors doing that. John, that changes the discussion.
You see that in the PMIs, Tom, on the manufacturing side. We need to see that in the PMIs on the services side, particularly in Europe. Tom, is it too early to say that we're seeing a little bit of a tantrum on a yield side of things? And I do wonder how self-limiting a move like this actually is. Out to 136.37.
Nice dovetail in here because Ben Laidler just out with research. Ben Laidler in the equity space saying the taper tantrum is overdone. I just looked, John, at the 10-year yield logarithmic, and there is not true convexity yet. You don't have the trends accelerating to a higher yield yet, but it's real close. Couple more days.
The bond market is the story this morning, worldwide and global markets. Coming up, we need to talk about COVID-19 with Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean from New York City this morning. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures pulling lower on the S&P 500, 38.72. We're down around about 31 points on the S&P 500. We are negative 0.8%. This is Bloomberg.
Good morning. In New York with the First Word News, I'm Karina Mitchell. Well, it is the first real-world indication that vaccination will curb the spread of the coronavirus. A study shows that the Pfizer and BioNTech vaccine appeared to stop the vast majority of recipients in Israel from becoming infected. The vaccine had an 89% efficacy in preventing laboratory-confirmed infections. Meanwhile, the U.S. and Iran are sparring over how to revive that nuclear deal. Over the weekend, Tehran renewed its demand that the Biden administration rejoin the accord and lift sanctions before any talks can resume. The U.S. response is that Iran is isolated diplomatically and the ball is in their court. And the next phase of President Biden's legislative agenda is taking shape. It's an economic package that will be potentially much larger than the $1.9 trillion virus relief bill that's now before Congress. The centerpiece could be the biggest infrastructure spending commitment since the New Deal. It all may be unveiled as early as next month. In Texas, a number of people lucky enough to have power during last week's bitter cold will be paying the price. They're getting massive electric bills and thousands of dollars. Gritty Energy charges customers based on real-time price swings in wholesale power markets. Gritty says it is just passing through its cost. The methodology is unique to Texas, where the retail power industry is entirely deregulated. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. Much more to come. Stay with us. This is Bloomberg.
have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Let's just start with the numbers.
It would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We're now on track to have enough vaccine supply for all Americans by the end of July. That doesn't mean it'll be in all Americans' arms, but enough vaccine will be available by that time.
President Joe Biden there on vaccine supply in the United States of America. The outlook in this country getting better, getting brighter, week after week. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Looking at this equity market right now, there's one story. It comes from the bond market, and it's pulling this equity market lower. We're down 32 on the S&P and negative 0.8%. Yields are higher by 3 basis points to 136.36. Yields aren't higher in Germany. That's important. Your German 10-year, negative 31 basis points. Christine Lagarde, the ECB president, speaking, Tom Keene, in a couple of hours' time.
Yeah, she's going to speak, and it's going to move the markets. The 10-year yield, I want to make clear, coming off of 1.39 about 3 hours ago, maybe 4 hours ago, and we've come down to 136, but nevertheless, there it is. We're watching it closely again. I'm focused on Swiss franc, which is really a bellwether of a changed landscape. Right now in the changed landscape of this virus, this pandemic, and all the good news we're observing when we look at hospitalizations and the improved statistics of deaths, is Joshua Sharfstein. He's with Johns Hopkins Bloomberg School of Public Health. Mr. Bloomberg, of course, a philanthropist to his engineering school at Johns Hopkins and all of JHU, and of course, founder of Bloomberg LP and this radio and TV property as well. Joshua Sharfstein, I get upset when I hear the media talk about herd immunity in simplistic phrases. You and I know it's some really interesting differential equations. Explain how pros like you take the fancy math of Diffie-Q and get us to where herd immunity clicks in.
Well, I think there are models of herd immunity, and then there's the reality of herd immunity. And so people can estimate when we think herd immunity might kick in and what that means for people. But then we really have to see it, because those models are generally based on assumptions. I think one of the key important points to remember about herd immunity is that you can have generally herd immunity, meaning that cases really don't have a good opportunity to keep spreading. But then you have communities where there's a lot of vulnerability. People haven't been vaccinated and few people have gotten infected that could wind up with pretty serious outbreaks as well as hospitalizations and deaths. So general herd immunity can leave some serious pockets. And then the second question is, what will it really take? And that may depend on how these variants behave and other factors we don't know about.
And one of the factors is the virulence of whatever you're talking about. Have you changed your perception of how virulent this vaccine is, this virus is rather, given the new variants that are out there?
Well, there is certainly some evidence that some of the new variants may be more lethal, but it doesn't appear to be, fundamentally changing the epidemiology of the virus so far in the United States. So right now, the cases are coming down, hospitalizations are coming down, deaths are coming down, but we know with 500,000 people who have died just how serious this pandemic is, and we can't let up. We have to keep pushing it down so that we can really minimize the chance we get in trouble with variants or any other kind of problem.
Professor, do you think we are underselling the vaccine at all?
I think the vaccine's pretty awesome, really. I mean, if you think about it, that within a year we have incredibly effective vaccines with very strong safety records, and you see now the data from Israel showing staggering declines in risk for people who have been vaccinated. Yeah. I think that there's no reason to undersell the vaccine, but we shouldn't think that, in a week after, that everything's going to be fine. There are a lot of risks out there. The way I'm telling people is, that list of things that you want to do when this is all over, you can't do them all today, but if you've been vaccinated and you're through that period, there are probably some things on that list you may be able to do.
Well, don't you think it would be more optimal, so to speak, to tell people who have had the vaccine that they can do the things on the list? Wouldn't that be a better way of selling this vaccine? So actually encourage people to go and get it by saying to them that you can start to return to normal once you've had it.
Well, I think you can say you can start to return to normal. I think that some people are really itching to be able to say it's all done, you're done, and that's not really a great message for everyone right now. But you, I think, can say, for example, that people who've been vaccinated can get together for dinner. You can go see your grandkids. Perhaps, depending on the situation, with a few modifications, but a lot closer than you were before. So, I'm fielding these questions every day from people, and they're just amazed when I start to tell them yes after a year of telling them no.
Yeah, it has a psychological impact, I would say, on everyone, particularly younger kids who have seen this as the majority or a significant portion of their life. Going forward, what's the time frame that you see at this point, given the vaccinations available, where you expect anybody to be able to go to their local drugstore or, say, a stadium and get vaccinated?
I defer to the estimates of the federal government. I think they're talking about the summer for adults, more or less, for that. Obviously, it's going to take longer for kids because the studies have to be done. But I think we're going to see that this is going to turn from an excess demand situation pretty quickly. I mean, in a matter of weeks or a couple months, to a vaccine acceptance situation where we really are going to be waiting for people to get ready for vaccination. And we need to start that process now, offering vaccines, answering questions, doing mobile teams. There's vast inequity in access to vaccination right now, and we should be fixing that, because that's going to turn into the most important end game for this virus.
Conversations like this are important. Joshua, we appreciate your time this morning. Thank you, sir. Joshua Sharfstein there of Johns Hopkins. Tom, it's an important conversation, and I do wonder whether they've held back on overselling the vaccine because they're somehow worried about establishing some kind of two-tier society whereby there are a group of people who have had the vaccine, you, a group of people who haven't, me, and you get to do things that I can't do.
Well, I don't know what I'm doing different than if I did not, because so many other people are out there. My life hasn't changed all that much. John, I would suggest it is science in that we are learning day by day. Granted, there was a big pause for that terrible cold in the Midwest, but I'm looking at the incremental day-to-day statistics. And John, I'm sorry, the trend is your friend.
Absolutely.
And the trends on hospitalizations, I'm looking at them particularly out of GHU at the 4 regions of the country, the Northeast, Northeast and the South are a little bit behind, but the Midwest and the West are wow trends.
Israel was always going to provide the forward look. And Lisa, Israel, the science, the data coming out of Israel, really encouraging.
Yeah, what strikes me is we're running a massive experiment in real time, right? I mean, because we are rolling out this vaccine that has been approved and does appear safe, but we're not learning all of the effects in terms of herd exposure until after it gets rolled out, which is the reason why Israel is the template, with, I believe, more than half of all adults having already received their first shot.
A job well done. And another reason to drive Treasury yields higher, and that really is the market story. The outlook is getting brighter, and the Treasury market can smell it, and it smelled it for the last, what, Tom, several months. That's been a story in the small caps and the equity market,
look at the 10-year yield. It's back up. It's printing a legit 137 right now.
Legit.
You get up and go through 138 where we were 4 or 5 hours ago. And again, John, you get towards that convexity.
A shift higher in bond yields, a move lower in the equity market. We're down on equity futures by 33, on the S&P 500 off by 0.8%. On the equity market, a man with a year-end price target of 3,900 and looking for a ton of churn beneath the surface. We'll catch up with Mike Wilson and Morgan Stanley coming up in the next hour. Looking forward to that. From New York City this morning, good morning. This is Bloomberg.
What's the biggest mistake you made when you were a fresh MBA grad and looking for a job?
Make sure you try to do something that you're interested in and that you think you'll be good at. I just was on a path to law school, and I actually never asked myself why I wanted to go to law school. And I randomly went to an investment banking analyst recruiting event, and I figured out I had an aptitude for it. I was interested in the work. If you're not interested in it, and it's not something you're good at, the money will not justify it. I also think that there's nothing wrong with experimenting. Doing something that you always thought you might want to do, trying it for a couple of years, you can then go back down a traditional path if that's what you want to do. Try to remember what you want out of a job, where you want to live, what you want to get from it, from personal experiences, from development, from training, from fulfillment, from engagement in the community, and make sure you think about those things up front as you're recruiting and not try to evaluate it after you got there.
Why are you running around the world saving the world from hunger? Why are you doing that?
I want to live in a world that I kind of believe everybody is doing as well as my daughters.
business sector has really, really taken a terrible hit.
Things are happening much more quickly. There's just no stabilizers.
You've got a lot of buying power out there with pent-up demand that continues to build.
We have seen people take the money that they get from the government and their income and spend it like mad.
I do think inflation is an eventuality, and that is the only thing that will probably knock the market off course.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Equity futures down 0.75%. Stories in the bond market, Tom Keene. Yields higher 4 basis points, 137. Your yield on a 10-year.
Looking at the Bloomberg terminal here, John. Good morning on radio and television. It's simple. The 10-year yield spikes up in the last 10 minutes. We're not out to the 139 highs of the day, but John, we have gone from under 136 well out over 137 in a matter of a cup of coffee.
The 30-year out to 216, up 3 basis points. Yeah. And Tom, the story of the week is going to be the Fed speak and how they respond to what we've seen in this bond market in the last week or so.
And dovetail it together, folks. Rarely are John and I on the same page like we are right now. It's not only the Fed speak, but John, what we haven't talked about is a 10s, 30s curve is one of those tea leaves to higher yields to that reflation trade. And you got to watch to see if you get a steepening there with a higher 30-year yield and relative to the 10-year yield.
Lisa, yields up, curve steeper.
Well, if you look at the 530s, if you want to get technical, it's reached the highest point since 2014. So when you take a look at that reflation trade, it's being borne out in a serious way. I'm not correcting you. I'm just explaining what I'm seeing.
She's
but John,
explaining.
You're right.
It's like we're married. She's explaining.
Is there something you want to say, Tom?
No, there's nothing I'd like to say. I'm taking a walk.
Okay. John, save us. But I will say this, that this reflation trade is based on the fact that we're getting a faster reopening than expected and that stimulus plan coming through.
I love that. I'm not correcting you. I'm just explaining what you should have said. Just beautiful. Monday morning, good morning to you. It's a market that looks like this. On the equity market, equity futures down to 38.76 on the S&P 500, negative 27 and down 0.7%. Yields are higher by 4 basis points. A real lift as well in the last 20 minutes or so.
Yeah, that's great.
137.38. Crude coming along for the ride, 59.69. Jeff Curry at Goldman, Tom.
Yes.
Talking up 75 in Q3 of this year.
Matt Miller talking up the tin spread. I have no idea what that is, but everybody, they were on London Medical Exchange on surveillance, the early edition as well. John, should we go to a point right now where we're not correcting and just explaining?
Just explaining. Just explain. Lisa explained to us what to look for through the rest of the week, the rest of the day.
I'm going to never live that down, and I'll own that. I'm going to explain to you that at 8:45 a.m., Christine Lagarde, the head of the ECB, will be speaking at the European Semester Conference. Very interesting to hear what you've been talking about, John, all morning, which is basically this idea, how do they respond to a tightening in financial conditions that does not stem from their fiscal plan, that does not stem from their successful COVID vaccine rollout, but instead stems from the United States and what they're doing and the concern that this could tighten growth insufficiently to allow longer-term growth to pick up. Then at 9 a.m., Janet Yellen, Treasury Secretary, speaking at a New York Times Deal Book conference. Very interesting to hear her comments on overheating. She's not that worried about that. She's talked about how there's a bigger risk of undershooting at this point than overshooting. Also, very interesting, the relationship between the Treasury and the Fed as yields go up. How much are they relying on the Fed to suppress those yields? Then at 1 p.m., House Budget Committee will be taking up the $1.9 trillion stimulus package. We've talked about the $15 minimum wage, state and local funding. That will be an issue of contention. But also people will be looking for signs that there is consensus among Democrats to push forward to yet another bill on infrastructure spending later in the year, John.
Lisa, thank you. Good explanation. Things are getting better. Things are getting better. A headline crossing the Bloomberg from a German sportswear manufacturer that we all pronounce differently. Tom, you one way, me another. Weighing in and lifting its dividend, resuming its dividend to propose $3 per share for 2020. We're seeing a lot more of that.
And Goodyear moments ago to buy Cooper Tire for about $2.8 billion equity value in that deal. It's a smaller deal, which shows how difficult the tire business has been. It's like the M&A thing that's going on.
Encouraging, Tom. Encouraging. Yeah. Global growth picking up. Commodity market breaking out. Copper, Tom, talked about it in the previous hour, flying.
Well, yeah, 3 standard deviation move. I mean, there's no question about it. I just did the math. You can do this easily on the Bloomberg terminal, folks. You need one at home. But John, it's a nice move. It's exactly 3 standard deviations.
Was that the plug for the Bloomberg terminal?
Yeah, I have to do one. Yeah, Mike called in from
You get a Bloomberg terminal.
Said,
you get a Bloomberg terminal.
That would be quite the Oprah episode for Wall Street.
Yeah, he did. You know, I got another plug here. It's Mike on the phone going, say this, say that, or something like that.
Tom, let's bring in Krishna Mamani,
Let's do
Lafayette
that.
College, the CIO. Krishna, great to catch up with you, sir. When does the buying start to come back in? When does it return to this bond market at the long end?
Well, so I think bonds today, in the current environment, to me, represent decent value, much better value than they were before, obviously. If you are a believer in the reflation trade, then then perhaps you are waiting. And I think at the moment, that's what is driving this more than anything else. There are more believers in the reflation trade than perhaps need to be. I think people who are thinking in reflation terms basically have to look at the market in the following way. That is, what is growth going to be this year, and what is likely to be the growth outlook for next year? This year, we know everything is falling in place, and just from base effects, we are talking 6, 7. You pick a large number. But the real question is, what is growth going to look like in 2022? And I think that growth is probably closer to 2% than it is to 4%. And if that is the case, how do you sustain the level of reflation or sustain the level of potential inflation and really worry about overheating in the current environment? I have great difficulty with that. So I think the reflation trade will work for a bit, but by late this year, it's going to start fading. You believe that? You buy bonds today.
22 closer to 2. I just want to frame that, Krishna, because it's actually quite a big call. Looking at the terminal right now, 3.6% is the consensus forecast, the median view, going out through 2022. We had Ellen Zentner of Morgan Stanley last week come on and talk up 5% GDP growth. Why down by 2, Krishna?
Well, so when I say 2, I mean the point I was trying to make is it's not 4, it's closer to 2. So
Gotcha.
It's probably somewhere between 2 and 3% for 2022 is what my view is. And the reason is, the savings rates are high, and given what we have gone through, and considering the current level of stimulus as income replacement, and it doesn't get spent and it gets saved, it'll provide a higher trend growth outlook for next few years. But that outlook is not going to be a couple percentage points. It's probably going to be maybe 0.5 to 0.75% rather than 2 or 3% that people may be expecting. Things haven't changed that dramatically, other than the fact that when we were losing income, we replaced people's income.
Krishna, when does a bond market click in for bonds? Right now, the Bloomberg Total Return Index, the aggregate index, is down about 2% from the August highs, a 2% loss in that blended bond portfolio. We talk about bear markets in equity, but never in bonds. What percent down is a bear market for you in bonds?
Well, so bear market, if you look at the history of that series, it's very rare to have a prolonged period of drawdown in that index. So I think the bear market in bonds ends up being, to some extent, self-correcting. Because when rates rise and there ends up being slowdown in growth in a very short period of time, and therefore bonds turn positive. And I think to some extent that is probably going to happen this time also. So the real question is, does it happen in late 2021 or does it happen in 2022? In my mind, really, that is the only question. We were headed to sub 2% rates, or even, I would argue, sub 1% 10-year rates normally, even without COVID. So we got here in a hurry. Again, nothing has fundamentally changed from a structural growth outlook. You can talk about reflation as much as you want, but once the stimulus is kind of passed through the snake, then there is really no significant driver on the upside.
Krishna, extrapolating that view out into equities, does that mean that the reflation trade in equities has gone too far with small caps and some of the more cyclical parts of the market?
No, I think the reflation trade in equities is really more, I wouldn't call it a reflation trade as much as it's a growth outlook improving trade. And that has more to go. And I think, while the two may be correlated, they may not exactly be correlated. One may lag the other. So my expectation would be bond markets probably find the end of the reflation trade before the equity market find the end of the reflation or the better growth trade. And that probably lasts more of 2021 than the bond reflation trade, in my view.
Krishna, always great to catch up, sir. Thanks for being with us. Krishna Mamani there of Lafayette College, the CIO, with yields high by 4 basis points to 137. Keep talking about this reflation theme, Tom. Actually, last week there was a period of time where we saw real yields breaking out and inflation expectations. Inflation, part of the trade, rolling over a little bit. It's been a real yield story over the last week in a much more profound way, a bigger way.
Yeah, there's three numbers in there, folks. There's the nominal yield, the inflation dynamic, and the residuals, the real yield. And I agree, John, they're all three important, and I don't know which one matters. I know to you the real yield's the only thing that matters because your property's seen Friday afternoons on Bloomberg television. But there's a dynamic here of those three numbers.
Well, there we go.
It could be a surprise. Very nice, you know.
You got it in.
We're teasing that for 1 p.m. Friday. Do you know what was interesting about the conversation last Friday?
Yeah.
I called it therapy for bond market investors. We had the likes of Bob Michael at JP Morgan Asset Management talking up small caps, international small caps. Had Troy Gayeski of Skybridge talking about the equity trade too.
So, Lisa, should we mention that it's Washington's birthday and that George III, back taking notes from Lord Pharaoh, said George Washington was the greatest man in the world.
Okay, we can put that in.
February
Thank you. Duly
22,
noted. I did want to just make one note
birthday,
on, you guys were calling me gloom queen. I'm going to keep talking. But what you're talking about, John, this sort of increase in real yields and not inflation expectations is the reason why people are concerned about disinflationary trends. And I'm going to go back to that because that's exactly the point.
She won't let up.
Did we ever call you gloom queen? Have we ever called you that?
I don't know. Have you?
Maybe we should start. I just don't recall ever calling it you.
How about that,
Gloom
Washington.
Queen. Gloom Queen here every
John,
morning
once an hour, we got to get a dose of this?
No, I think it's more than once at the moment.
John, Tom, what are you drinking?
I love what Tom's having, to be honest with you. Equity futures down 29 on the S&P. We're off by 0.75%. Coming up later in the 8 a.m. hour.
This is great without celery.
Lisa Hornby of Schroders. This is Bloomberg.
In New York with the First Word News, I'm Karina Mitchell. A study from Israel shows that Pfizer-BioNTech vaccine appears to stop the vast majority of recipients in Israel from becoming infected. It is the first real-world indication that immunization can halt the spread of the coronavirus. A draft of the study says the vaccine is 89% effective. However, some scientists are disputing its accuracy. Meanwhile, in the UK today, Prime Minister Boris Johnson will announce all schools in England will reopen starting March 8th. Johnson will be in Parliament outlining how the virus lockdown will be lifted over the next few months. More social contact will be allowed starting March 29th. That will include outdoor gatherings of either 6 people or 2 households. China is urging the Biden administration to scrap tariffs and restore goodwill. The Chinese foreign minister says the two sides should reopen dialogue that was cut off under former President Trump. He reiterated the need to remove what he calls unreasonable tariffs. He also cited curbs on Chinese media and students as other areas of concern. And a new report says Americans are underinsured when it comes to flooding. According to First Street Foundation, which looks at climate risk, U.S. homeowners face $18.8 billion in flood damage annually, but insurance premiums set by the federal government would cover less than 1/4 of that amount. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Spending on pandemic recovery now, spending generously, is not a competing with a longer run investment program. In fact, it's a precondition for that longer run investment program. We need to get people back to work, and we need to get people through this with minimum damage.
Paul Krugman, a Nobel laureate, on the debate of the moment from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's your market this Monday morning. It looks a little something like this, with equity futures coming down 0.75% as the bond market breaks down and yields head higher, up by 4 basis points. Let's round it up to 137 on a US 10-year. Higher yields, a lower equity market. In foreign exchange, the euro hanging in there, 121.38. And in the commodity market, crude high, 59.75, copper through 9,000, absolutely flying. And just to pick up on the words of Paul Krugman there, Tom, it shouldn't be competing with an infrastructure program. I think the fear amongst some economists is that it will.
Well, yeah, you know, John, I think the huge deal here is the allocation, the makeup of the stimulus deal or the two deals to come. There's any number of ways going here. And of course, Steve Hanke and out on the Wall Street Journal today with a showing, walking nicely through the M2 buildup that we've seen in money, that wall of money that's out there. Kevin Cirilli's familiar with that. Kevin Cirilli, our chief Washington correspondent. Casey, I want to cut right to the chase, which is the number really 1.5 trillion, 1.9, or do you presume, like all of us, that somehow it grows and grows as they finally get to the end of the legislation?
You know who the most fascinating person to watch in all of these talks over the next 2 weeks actually isn't a House member nor a senator. It's the Senate parliamentarian, Elizabeth McDonough, because she's going to have to make a ruling at some time within the next 10 days. And she's hearing arguments from senators on the left and the right about whether or not they're going to be able to move through this process if they allow for there to be an increase in minimum wage. Remember, not to get too wonky on you, but if they are going to be held,
if you didn't, please.
If they are going to be held, this is how I spent my weekend. If they are going to be held to a $15 minimum wage, then they can't add to the budget over the 10-year period. And so when Senator Joe Manchin, the Democrat from West Virginia, the centrist, came out and said that he is not going to rule against the Senate parliamentarian, you have a situation where Vice President Kamala Harris might have to cast another tie-breaking vote for Democrats to override the Senate parliamentarian.
What's the power of the middle on this Monday morning?
Massive, because Senators Kyrsten Sinema, a Democrat from Arizona, as well as John Tester, another centrist Democrat, I mean, they are saying that they are very uneasy about the minimum wage going up to $15 an hour. It's why last week I was reporting that President Biden, facing that pressure, needed to back off some of that dug in on the $15 minimum wage. He had to back off a little bit, and he did.
Let me just bring up the words of Paul Krugman just quickly, Kevin, so you can weigh in on this, that the infrastructure spending shouldn't be competing, or rather the spending that we're about to see shouldn't compete with infrastructure investment. It should be a precondition for it. Do you see it as a competition between the two, the plan that's about to be secured and the plan that people want to see afterwards?
It's a competition in the sense of how Democrats want to pay for it. Republicans are in agreement that there needs to be infrastructure, but the massive divide is how both sides achieve that goal.
Okay. Can you elaborate, basically talking about tax hikes here? The idea, how much are we going to deficit spend and how much are we going to raise taxes? Who's on what side of the debate?
Well, you've got Senate Budget Committee Chairman Bernie Sanders, Lisa, who is saying more. And then you've got Republicans who are saying not so fast. And I think from the infrastructure perspective, when many folks in Washington were incredibly surprised in conservative circles that President Biden and the administration would lay down a gauntlet on immigration and try to achieve that goal as well. The window for significant policy changes is rapidly closing after the $1.9 trillion stimulus comes to conclusion. But there are so many different dynamics here. The only way that I think Democrats could see their chances for infrastructure significantly improve is if there's some type of cybersecurity element and cyber infrastructure. Tomorrow, of course, is the SolarWinds hearing on the Senate Intelligence Committee. Later today, I'll be interviewing the chairman of that committee, Mark Warner.
Well, but you raise a really interesting point. The idea, is there political will to raise taxes, or does this all have to be agreed upon on a deficit spending basis right now?
You know, we're going to find out from Elizabeth McDonough, and that's really the biggest unknown variable. And so she is the political referee that is really going to, if you're trying to figure out the timing of when this money gets into the economy, it really depends just from a process standpoint, if Republicans and Democrats in the Senate are going to have to hold a remarkable vote to overturn her ruling.
Kevin, did I just hear you plug sound on and you have Senator Warner on? Did I hear you do? You slipped that in nicely.
I'm learning. See, this is why I just learned from the three of you.
Yeah,
every
it's called
day,
the Pharaoh School of Hype. Kevin, is Senator Warner in the middle? What kind of middle is Senator Warner of Virginia?
Well, look, here's someone who has deep experience in the telecommunications field. He's someone who knows a thing or two about cybersecurity. You can't talk about potential secretaries of state, to be candid, and not talk about someone like a Mark Warner. He's got a lot of history. At one point was thought to be rumored to be a VP or a presidential candidate in previous cycles. And the top Republican on that committee, Marco Rubio, you know, they have a lot of common ground. When I come on here and report about China and the common ground that Republicans and Democrats have, the really bedrock of that is from the Senate Intel Committee.
I'm told I've got to promote this now. Kevin, thank you.
It's a Pharaoh School of Hype. Here we go.
Editor-in-chief, Chief Washington correspondent, host of Sound On Bloomberg Radio weekdays at 5 p.m. Eastern Time. Do you know what Kevin did to me the other day? He said I sounded like Senator Warren. So that's what he said, and I still haven't confirmed with you whether that was a compliment or an insult. I'm not sure where you were coming from.
The reason was she had a phrase that said banking should be boring back in 2013, and then you said banking should be. That was where the parallel. I'm not trying to step in anything.
I said committee hearings should be boring.
Kevin's success in stepping in something.
That's the wonkiest interview he's ever done with us. That was a total Sunday nerd fest.
I thought that was fabulous. This question of taxing versus deficit spending is huge.
I got like 8 more questions, but I know there's no time.
He's got to go. Kevin, it's great to catch up. There's no time because shortly we'll catch up with Mike Wilson at Morgan Stanley, Tom.
Yes.
And I'm really looking forward to this conversation. A man who has a year-end price target of 3,900.
We're there.
Understand sticking with it. We're there. And looking for the churn beneath the surface. And let's be clear, that's the more important part of this call. Away from the index level is what happens beneath the index level. And we're starting to see a lot more of that in the last few months.
That's one of Bette Midler's greatest hits, the churn beneath the surface.
Honestly, I've got no idea where this show is. Can you tell me? I'm still trying to think about this from a little bit earlier. Why did you bring up President's Day a week after it
President's
happened?
Day because, John, it's un-American that we have one day called President's Day when we have our first and our 16th president, where we have February 12 and February 22, and it just, I mean, I
John,
get the 3-day weekend thing.
How are we supposed to pick up on that?
I don't know.
I'm sure there's a British equivalent.
So, Tom, let me be clear. You think President's Day should be today?
It should be every day. Lots of president days.
It should be the 12th and the 22nd, as in my
We should
youth.
get 2 days.
I'm sure
We should get
there's a
2
British
days off.
equivalent.
He's arguing for vacation.
William and Harry's birthday or whatever.
Okay. Equity futures down 28. We're off by 0.7 of 1%. Bond yields breaking out. The greatest crutch ever developed on this program was
absolutely
just
phenomenal.
those markets. Check out those markets. Mike Wilson of Morgan Stanley coming up shortly. This is Bloomberg Surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
From New York City for our audience worldwide, this is Bloomberg Surveillance live on TV and radio, and here's the price action. 4-day losing streak about to become 5. We're down 0.7% on the S&P 500. On the NASDAQ, off by a little more than 1%. You know the story. You're familiar with it. It's about real yield. Switch up the board and get to that 10-year real yield. It looks a little something like this, crushed off the back of the pandemic, the height of the pandemic by the Federal Reserve, and then this slight inflection in the very last couple of weeks to negative 78 basis points on 10-year real yields. That's upsetting the valuation of big tech. Saw that in the equity market. Upset something else potentially, Tom. Let's finish on this, on foreign exchange. Switch up the board and look at things like the Aussie. Look at things like the commodity currencies, the NOK, the Norwegian kroner as well. We've had a 12% move, 12% move on both of these currency pairs in the favor of the Aussie and the NOK, Tom. And I think that's the story we've got to think about a little bit more. A huge short position around the US dollar coming into the year. And Kit Jukes of SocGen raising this question too. When do real yields, Tom, start to bite and drive things the other way? Yeah, well, the yields are there. And I'm also going to note renminbi has not broken through to new yuan strength. There's 6.46 on yuan, not 6.44. John, I would note that the 10-year yield makes another leap up in the last 2 hours, 1.38%. I'm with you. And that's the story we've got to build on this FX market, and not just in foreign exchange, in commodities as well, which is why I put the Aussie and the Norwegian kroner on there as well, because this is a double hit if you start to think about it. Does a stronger dollar, if real yields start to bite into the FX market, not only weigh on some of these trades, but also on the commodity side of the trade as well. We've had a huge move in copper, a huge move in crude, huge move in EM equities, and underpinning that is this weaker dollar call. The real yields start to challenge the consensus view. Story a little bit later on this program. Let's get you some movers. Here's Romain.
Yeah, a few big narratives going on in the market, John. Some of them that you're touching on. We'll start off, of course, with what's going on in the vaccine space. We had that Israeli study of that Pfizer-BioNTech COVID-19 shot, basically showing that the real world efficacy is actually a little bit better than what it was in the lab. That's good news, of course, for Pfizer. Keep an eye on some of the other COVID stocks out there, though, because some of them are actually under pressure now. The idea here that Pfizer, J&J, and Moderna are basically the leaders of the pack here. So a lot of people still betting on CureVac, but you're seeing a lot of those other names going a little bit weaker here. Also seeing a big upgrade here across the airline space over at Deutsche Bank, upgrading to buy American Airlines, Southwest, Delta, basically the whole lot of them. And this is basically all predicated on the idea hospitalizations are going down, vaccinations are going up, and people are starting to get out there and travel. And you just mentioned copper here. Copper has been on an absolute tear. We saw 9,000 over in London a little bit earlier. Remember last week here on the COMEX, we got above $4, and the Freeport-McMoRan has just been on fire. Highest level since 2014. Southern Copper, its larger rival, right now trading at a record high. So keep an eye on that space. Those three stocks right there, that's your reflation trade there. Flip up the board. A lot of information going on today in the deal space. People's United. This is good. You got that there. Great. This is a big deal here. Yeah. M&T and People's United basically combining here. Remember, we've seen a lot of combinations here of these regional banks. Remember, you had that big deal for Huntington Bancorp back in December, and of course the PNC deal back in November. This is basically two things here. First of all, some of these regional banks are getting a little bit too large. Once you get to like $200, $250 billion threshold on assets, those new regulatory requirements kick in, so it's better to be bigger. And then there's just the issue of these persistently low rates. Yeah, sure, rates have come up recently, but this is an environment where you can actually be more nimble by being larger, and these companies have to combine if they want to compete.
You know the reputation of M&T Bank of Buffalo. What's great about this is they take out $300-some million in costs, and they're saying day one, this is an accretive transaction, which, you know, frankly, with the great bull market we're in, Romain, is quite an accomplishment.
Yeah, and I remember when that Huntington Bancorp deal came out, one analyst told me this is almost a no-brainer, that if you're a bank and you have the stock and the ability to do this, there's no reason why you wouldn't do it. Exactly. Just real quickly here, Cooper Tire also being bought in a deal with Goodyear Tire. That's about a $3 billion deal. And interesting news that we got, according to people familiar with the situation, activist investors apparently been kicking the tires on Kohl's, trying to nominate 9 directors to that 12-member board. We'll see how that shakes out.
Right now, Romain, thank you so much. Romain Bostic with us. Look for him on the close this afternoon. Right now, a joy to have Michael Wilson with us. Mike Wilson with Midwest Academics out of Michigan and Northwestern, legendary at Morgan Stanley, and he joins us now for an update. I love what you say, Mike Wilson, about the alpha and the beta. This is not options dynamics, folks, delta, gamma, all the other Greek malarkey we talk about. Mike Wilson, it's about relative performance versus absolute performance. Parse that.
Yeah, well, thanks, Tom. I mean, look, I think that's what this year is going to be about, right? Last year,
we were obviously in the midst of the pandemic, the lockdown, the economy was falling apart. And of course, stocks discounted the recovery, and it was really a beta trade, meaning everything kind of went up together because everything had gotten crushed at the same time. Now it's about, okay, well, where can I find the sort of needles in the haystack, the stocks that are companies that are going to really outperform as we reopen. And oh, by the way, there's going to be some losers as that happens too, right? There's going to be a wallet share shift as we go back to normal. There's going to be cost pressures. You were just talking about the reflation trade, something we've been on for quite a while. That's going to create some cost pressures for many businesses. So we want to take advantage of that. We want to take advantage of the companies that can benefit from that environment, and then try to avoid those that are going to be punished by that. And it's just on
individual stocks with the Morgan Stanley Research Combine. You say the haystack. What are the sectors in a haystack?
Well, you were just talking about one. It's the banks, right? So we've been on the rate trade for a while. We've been on the reflation trade for a while, and we think, look, let's take advantage of that. I mean, there are going to be companies that benefit from higher rates and higher commodity prices. So materials, metals, and mining, obviously the banks, clearly some of the cyclical parts of technology that have benefit from a reopening of an economy. Maybe the industrial sector as we get an infrastructure bill. Those are going to be areas from a sector standpoint that could do quite well.
Mike, let's just build on the year-end call, 3,900. I imagine you filled a lot of calls, and they say to you, Mike, 3,900, why haven't you lifted your price target? Is this just down to the member weightings, the sector weightings, just the mechanics of the makeup of an index like the S&P 500?
Yeah, I mean, let's talk about the S&P itself. It's really a large cap growth index, John, as you know. And, I mean, those stocks have done terrifically well over the last decade. And part of that story has been the fact that rates have come down, right? They're great businesses, but they've been overvalued because rates are, been repressed. And if that's changing now, well, then, look, their multiples are going to come down probably more, perhaps, than what the earnings can offset. So 3,900 is a good – I still feel really good about that target at year-end. We have a bull case of 4,150. Okay, fine. But that's not the story. The story is what's going on underneath the surface. I mean, you mentioned it earlier, some of the metals and mining stocks, some of the bank stocks that are really doing well. These are the opportunities for portfolio managers to find.
What I've really enjoyed in the last couple of weeks catching up with you guys at Morgan Stanley is just putting all the pieces together. Alan Zettner last week of Morgan Stanley talking up 5% GDP growth next year, 6.5% this year. I imagine a Matt Hornback high yields call is in there as well, Mike. Can you just put it all together for us, join the dots between the different calls coming from the bank at the moment?
Yeah, I mean, the macro team has really been in sync over the last 12 months. I mean, because the pieces have come together. And, Ellen's call on the economy, Matt's call on rates, our call on kind of the sector dispersion and rotation that's been going on. It's all part of the same narrative. And it goes back to almost a year ago now. It seems like it was yesterday. But a year ago, we're talking about this regime shift as we move from a monetary policy dominant regime to a fiscal policy dominant regime. And it's clear now that that's what's happening. What does that mean? It means a higher velocity economy. It means higher nominal GDP. It means inflation. And those are things that are going to change what works going forward.
So within the churn can be nice, and it can be, for example, a hot tub, or it can be the ocean where you're getting smashed against the shore. And there's a question about how much leverage there is beneath the surface. It's going to lead to some pretty violent moves. Mike, what's your sense of how much leverage has been pushed out of the system, or how much has been built up in preparation for a relatively violent churn over the next few months?
Well, that's right. I mean, I think one of the things that we're not that comfortable with at the moment, to be honest, is it's been really a one-way risk market. Okay, there hasn't been a lot of two-way risk. We had that little, snafu in January. We had some short covering and some deleveraging that went on, but we're right back to those high leverage areas. When I say high leverage, I mean across both the institutional world and the retail world. We've rarely seen leverage this high, and that can bite both ways. And so the wild card to me is, let's say that we go into the reopening phase, which looks like it's going to be sooner rather than later. Some of these cost pressures arise. We do have supply chain issues. This event in Texas with the weather is not helping that, by the way. So we could have margin pressure. We could have rates go up more quickly than people are anticipating in valuation. So I think that leverage will create more two-way risk. We'll create some more volatility in the marketplace. And by the way, we'll create some opportunities in the areas that we do like.
That's exactly what I was going to say. How do you use that? How are you preparing to jump on that with respect to specific market calls?
Well, we're advising clients right now to probably take their leverage down. I mean, we think people have leverage that's too high. That look, things are, even in the things that we like right now, they're a bit ahead of themselves. And we wouldn't be surprised if we had another surprise over the course of the next 30 to 45 days, and we get a bigger correction. And so, like, run lower risk right now. Let's take advantage of the drawdown like we got in January, or like some of the drawdowns we got last year.
Mike, fantastic to catch up, sir. Great work as always. Mike Wilson there, Morgan Stanley CIO and Chief US Equity Strategist. On this market, still very comfortable, Tom, with a year-end target of 3,900 and looking for a lot of churn beneath the surface.
You know, we're going to get 10 different opinions with 12 different interviews. I mean, John, it's just real simple here. There's a lot of different opinions. It's a big run. I see few people anticipating a leg up. That's the minority view right now, is the leg up, and I guess that comes off of earnings. I don't think it comes off disinflation.
I think Mike's view, Tom, is pretty intuitive. If you just look at the mechanics of the S&P 500, 28% of it is information technology. And if you think that those valuations have been supported quite heavily by real yields, well, real yields are moving the other way.
And John Abramowitz grinding it out for CFA level 4. What was that? What is the hot tub hypothesis?
The idea hold on a second. The idea here is that markets aren't neat. They don't move in a linear function historically. And they have been really neat. And so when you talk about churn, I was just thinking with water.
We appreciate that explanation. I just wonder how you got from the hot tub to a rocky beach somewhere.
A hot tub is a very nice churn.
That's not appropriate for radio. I mean, TV, we can say that, but radio,
no idea where this is going.
Well, never mind. It obviously failed.
Are you guys okay this morning? You okay? Things all right. Both of you. I've got no idea what's going on.
She's got the hot tub going out by the ice rink. Let's run this through. Lisa, you're living this right now.
Yeah.
In New York City, John, for radio and TV, you need an ice rink. And we have an ice rink in Central Park. And Lisa, there's this uproar over the ice rinks.
Well, what happened is that they were going to close them early. There's nothing you can do in the city, not very much during a pandemic. I mean, you can be outside, and when you've got kids, you're trying to get them out of the house. Who is that? Is that Joe's? Is that the afterthought?
That's afterthought. The gentleman dropping the puck is one of our great employees at Bloomberg. That's Woolman Rink, John Farrow.
Take us out with
I've been there with you, Tom. I've been there with you on a Saturday morning, and you refused to put on the skates.
Yeah, well, the coffee was $7 a cup.
Is that how much it was?
Feeding the kids is like $30.
Lisa's fired up about an ice rink, but it's coming out in different ways this morning.
It is.
Lisa Abramowitz and Tom Keene.
Later.
I'm Jonathan Ferro.
Maybe Trump will put in a hot tub.
Coming up. Can we stop there, please? Dr. Jonathan Quick, the Rockefeller Foundation Managing Director of Pandemic Response, Preparedness and Prevention. Coming up shortly, a serious conversation around the corner.
Yes.
This is Bloomberg.
With the First Word News, I'm Karina Mitchell. It is the first real-world indication that vaccination will curb the spread of the coronavirus. A study shows that the Pfizer and BioNTech vaccine appeared to stop the vast majority of recipients in Israel from becoming infected. The vaccine had an 89% efficacy in preventing laboratory-confirmed infections. In other news, the U.S. and Iran are sparring over how to revive that nuclear deal. Over the weekend, Tehran renewed its demand that the Biden administration rejoin the accord and lift sanctions before any talks can resume. The U.S. response is that Iran is isolated diplomatically and the ball is in their court. Airlines in the U.S., Japan, and South Korea have grounded Boeing 777s following that explosive engine failure over the weekend. United Airlines Flight 328 made an emergency landing in Denver after one of its Pratt & Whitney engines suffered a fan blade failure. Boeing is urging that all 777s with those engines be inspected. Boeing and United shares are lower pre-market. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
think they have a very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kayleigh Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
It's stunning when you look at the numbers, almost unbelievable, but it's true. This is a devastating pandemic, and it's historic. People will be talking about this decades and decades and decades from now.
The kind of milestones you do not want to hit in the United States of America. From New York City this morning, good morning. That was Dr. Anthony Fauci speaking to NBC over the weekend. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Here's your market. 12 months ago, the equity market was just about topping, and your 10-year yield was in and around 138, Tom. And we're back to those levels now. 137.89, up 4 basis points on a 10-year, and an equity market pulling back from all-time highs. 4-day losing streak can become 5. Probably will do at the opening bound. Down 34 points, Tom, and off by 0.9%.
Well, the morning action, I would say yields higher now for a second oomph up to get out to a 139 is a big deal. Of course, a 140, a bigger deal. We're not there yet. Again, the VIX 24.62. The VIX is a higher VIX over the last 2 hours of our simulcast on radio and television. This is a joy because it's a view from 60,000 feet. Jonathan Quick out of Harvard and the Strong Complex in Rochester is definitive at the Rockefeller Foundation as their managing director of pandemic response. The book is The End of Epidemics, and it was prescient beyond all belief in 2018. Dr. Quick, thank you so much for joining us. How do pandemics end?
Pandemics end like this end when there's enough people that are immune, basically when the virus runs out of fuel. And we'll get there with this coronavirus, when we get 70+% immune, either from natural infection or from vaccination.
In your book, your last chapter, you say, rouse the leaders. Are we doing okay? How is the leaders doing?
Well, they're roused. I think what we've seen in the last couple of months, over the last month especially, we're really seeing a mobilization, and I think a real unity of messaging from the top in the U.S. and it continues worldwide. The focus on vaccination, the focus on continuing to practice safe living precautions. I think those are vital, and I think we're moving ahead on those.
Dr. Quick, you're a couple of days away from full immunity after getting your second shot. Congratulations. And you and others are wondering, okay, well, what do we do now? And the initial information out of Israel is that there is protection against infecting anybody else for those who have gotten vaccinated. Is this an all clear sign? Do you think that you will change your behavior based on those studies?
I'm gonna keep my behavior just as it is which is continue to be cautious with masking and distancing and all until the CDC has looked at all the evidence and our own context here in the U.S. and given the all clear.
Okay, so in other words, you don't think that necessarily the information that we've gleaned from that Israeli study is enough to really say, okay, go out, have a pandemic party as soon as you've done with the immunization?
Yeah, right. I think the thing is, you don't get a do-over. So I think when we start making changes to relax restrictions and all, we need to be really sure, particularly with the specter of these variants on the horizon.
Are the vaccines that we have help us with future COVID viruses? Not this COVID viruses, but others to come through the years?
Yeah, I mean, what we have now, I think folks need to understand that the reason why we've been able to break all records on vaccine development is that we have new technologies for the development of the virus and vaccine and production. And so the companies are already adapting the vaccine to reflect the impact of some of these different mutations. That's one. The second is that this set of vaccines has attacked primarily one part of the virus, but there already is research going on that will let us attack multiple parts of the virus, which means when there are new strains, when there are mutations, we're likely to be in a much better position to have a vaccine that really covers a broader spectrum of changes in the virus.
Dr. As we're imagining the future, let's just build on that a little bit more. Tom has had both doses of his particular vaccine, and in a number of weeks he'll be in the same situation that you're in right now. Do we know when we have to do it again? Is it 9 months? Is it 12 months? When do we have to go back for more?
So we won't know that until we've gone through those months and seen how people's, both the measurable antibodies, but even more the actual level of protection in practice. We know from the two other coronaviruses that have gone global, SARS in 2003 and then the Middle Eastern one in 2012, natural immunity from those lasted 24 to 36 months. So we'll undoubtedly need a booster of some kind, but the interval is still to be determined just by the experience with these vaccines and this virus.
Doctor, thanks for weighing in on some of the things that we still just don't know. Dr. Jonathan Quick there of the Rockefeller Foundation. And Tom, to your good question, there are plenty of things we still do not know, and they are important things as well.
Yeah, it's a learning progress, and that was the way it was in the 50s and the 60s. It's, this is virus 101. And John, the one thing I'd go back to within all the analysis and the keeping of statistics is every pro we talk to, from Quick at 60,000 feet down to the granular like Deborah Fuller out at University of Washington, they're all stunned at how fast we got these successful vaccines.
And things are getting better really quickly, and this bond market's picking up on that. That's the story this morning, so let's get there. Yields are higher, the curve is steeper, up 4 basis points on 10s to 137, on 30s to 216, up 3 basis points. Copper's flying, the Aussie is stronger, Aussie dollar out by another 0.25%. Lisa, things just started to come together again this morning.
Yeah, and I do wonder, to Mike Wilson's point, the idea of leverage building, the idea of strong, crowded consensus trades, how much these moves could overshoot before they correct. The whole idea of Robert Tip of PGIM saying he does like bonds here, but he's going to wait for this to play out.
The ultimate consensus trade, I think, that's got a real challenge right now, Tom. We touched on it about 30 minutes ago. Is this US dollar trade? Very bearish, the US dollar into the new year. Huge short position around it. Now we're starting to see real yields break out. That's a challenge to that call.
Well, the dollar call is the consensus trade. And John, as I mentioned earlier, the trade that I don't think is consensus is no one has visibility on earnings, on what we're going to see Q2 or certainly Q3. There's just a thunderous silence about what we're going to see from corporations.
Better and better is what people hope for. But I just tie in that US dollar trades, Tom, to two different things right now. Not just FX, that's the obvious. Commodities, 1. EM, 2. It's really interesting this is happening on the same morning. You've got real yields breaking out. You've got copper strong. You've got the Aussie dollar doing nicely.
Yeah, real yields up 3 basis points, no question about it.
Thanks, Tom.
Thank you.
Fridays,
Do you want to, you know,
I've just
Kevin's
done it.
got Senator Warner at 5 o'clock.
I've just done it.
Are you going to change it to negative real yield?
We could. I mean, got 80 basis points left of it. I'm not sure how long the show would last.
For radio, the real yield is an airplane flying over the Garden State Parkway with a real yield banner.
And we're done. This is Bloomberg.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
While the economy is looking promising, the recovery is still at the early stages and it's still quite fragile.
Things haven't changed that dramatically, other than the fact that we replaced people's income.
You've got a lot of buying power out there with pent-up demand that continues to build.
We have seen people take the money that they get from the government and their income and spend it like mad.
Inflation is an eventuality, and that is the only thing that will probably knock the market off course.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Across this nation and worldwide, we're thrilled that all of you are with us today. Important conversations on a market that is changing its dynamics. And John, it's all about good news on the pandemic. It's about a change to worries of reflation.
And yields picking up, Tom, up 4 basis points on 10s to about 137, on 30s to 216, up 2 basis points. And now we start to see, as you would say, Tom, that tipping point. Yields up, equities down.
And the other idea, John, is can the tipping point be advanced by Fed? 1, 2, 3, I've lost count of the number of Fed speakers. Maybe someone slips up in Q&A, or maybe it's in their comments.
Chairman Powell on script, Vice Chair Rich Clarida, I'm with you, Tom. Look out for that. Let's see if the script changes just a little bit. Any kind of verbal intervention, any sign of discomfort with what we're seeing in this bond market?
Yeah, Lisa Abramowitz, what I'm looking at is pushing against this, as Washington well knows they need to get reelected, is the American job economy. And yes, I know it's better, and there's been some charts over the weekend that show some nascent strength, particularly in the Midwest, but it's got to get better month after month.
Yeah, it's got to get better, especially because we've had a manufacturing recession in the United States for a long time, and we've seen a steady decline in the manufacturing jobs over the decades. And there's a question of what it could take to revive some of these blue-collar jobs that are in hot demand right now, Tom. How much can we get this pushing forward past the pandemic into a new trend line?
And getting, of course, restaurants and the rest back, as we well know here in New York City. John, I want to do a joint data check today. Sure. What I'm looking at is a VIX up 2.42 points. We're well out over 24 on the VIX. I'd also note the parsing in the equity market. To me, it's not a question of equities down. They're just off the bid is how I'd put it.
Yields up and equities off the bid, but we're down 0.9 of 1%, Tom. The read across is pretty clear. Real yields have started to bite into the valuation of some of these big tech players, and that's why you see the NASDAQ down hard again today as well. I'd go to the commodity market, Tom. We've got crude up 1%.
Yeah.
We've got copper up another 1.7% through 9K. We're really taking it back to 2011 in the metals markets. Back to 2011, numbers we haven't seen for about a decade.
Quoting Chicago copper right now. For those of you on radio, this is a running battle. Do you quote commodities off London, or do you quote them off Chicago? The convention in America is to look to Chicago. And John, the convention in London is to look to London. Are they different in price?
Well, I would say the convention for the miners that actually extract this metal out of the ground is to look to the price in London, Tom. That's what it's based off. That's what it's based off, and that's the story right now.
Each metal different, but we're seeing the Bloomberg Commodity Index folks come up here. So look, we've got such an important guest. Let's get right to it. We got tons to talk about across the next hour as well. Lisa Hornby with us with Schroders, head of their U.S. multi-sector fixed income, and she has to recalibrate. Lisa, what's the level of recalibration at Schroders right now with higher yields and lower prices?
Yeah, I mean, I think everyone's adjusting. We were just talking on the break, right, about GDP forecasts being revised significantly higher over the next, for the remainder of the year. And I think, part of that is obviously expectations for stimulus being greater than were expected, a better data on the vaccine front, and so a release of this pent-up demand that we see in the U.S. consumer. So that should mean slightly higher rates. It should mean steeper curves. The thing that I'm following the closest is really the move in real yields, which you guys were mentioning. I mean, Nominal yields have been rising for quite some time, but it's really only recently that we're starting to actually see this come through in real yields. And that's where we could potentially see some other markets come under pressure if this move in real yields essentially continues unabated.
I'd just like to add to the conversation in the commercial break. There was this individual sitting next to me who looked like Lisa but didn't sound like Lisa Abramovich, telling Lisa Hornby there was so much optimism around. Really enjoying the fact that there's so much optimism around.
Well, okay, I'm talking on a personal level, that when you walk around, you can feel like the sort of cloud is beginning to lift. Don't get me wrong, there's a question of whether we'll be on a different trajectory, and that's exactly what I wanted to go to Lisa Hornby about, that there's one thing to have reflation, there's another thing to have inflation in a sustained way, and when do we get to the point where we're ahead of ourselves on the inflation expectations, and it just leads to tighter monetary conditions than perhaps the economy can handle. It's crazy, I know, John, to talk about tight monetary conditions with a 1.3% yield, and yet here we are. Lisa, please.
Yeah, I mean, that's the big question, right? Is this rise in real yields going to continue? Is it actually going to feed through into other risk markets? And then as you say, you see financial conditions tighten. Look, I guess my view on it is that this is somewhat to be expected. It's not a taper tantrum-like scenario, one, because we're talking about it, and just the fact that we're talking about it now suggests that positioning is going to be more on sides in a higher yield environment. People are not coming into this, max long like they were perhaps in the past. The second thing that's different between now and 2013 is that there were a lot more sellers of duration in a higher rate environment. So the convexity hedgers that you had in the past, the GSEs and the banks don't have the same needs today to sell rates when rates move higher. And that should stop that vicious cycle from happening. So I do think we can get yields moving a bit higher here, but I do think that there's a bit of a cap. And the third element on that is that the Fed is likely to look through any inflation in the near term. They've been quite clear that they want to see inflation. So you don't have a risk, in my mind, of them moving prematurely and actually raising the discount rates. So it's a bit of a markets getting on side call with the idea that, hey, growth is going to be stronger in the second half of the year, and yields should reflect that to some degree.
Well, Lisa Hornby, just to frame this in another way, at what point do these yields that we're seeing in the Treasury market begin to compete with capital elsewhere when you've had valuations in, let's say, parts of the equity market predicated on yields staying much lower than they are right now? When do you start to see that competition for capital evolve? Are we already seeing it?
I think to some degree. I mean, you've seen the equity move let up just a little bit in the last few days, particularly in certain pockets of the market. So, obviously there's been a huge move in growth stocks, and maybe we see that this long-awaited transition to value to some degree because yields are moving higher. I think it doesn't necessarily depend on the level as much as some of it depends on the speed in which we get there. Certainly, if this is every day we move 5-10 basis points higher, that's going to cause a much more significant reaction in other markets. If we are gradually moving higher in kind of a step change fashion where things kind of pause, people reset, then I think we can see yields move, 20 or 30 higher without much damage being done.
Lisa, on a multi-sector basis, where are you comfortable now? Where do you hide with yield up and price down?
So there are some sectors clearly that benefit from higher yields. Banks clearly benefit from steeper curves, higher yields. The bigger question, I think, is not necessarily the higher yield environment, but actually it's the everything looks expensive environment. So how do you position in that as a multi-sector investor? And I think you have to focus on the pockets of the market that are set to do well. When we look at corporate credit overall, we see extraordinarily expensive valuations. Again, there are some pockets. We do think there's still some companies in the, let's say, more COVID-related sectors, although we are, I think, expanding the definition of what that means as we see companies that still have value. Taxable municipal market is another area that we see some opportunity where, the fundamentals in that market are quite strong. Fiscal stimulus certainly going to help this time around as there'll be more set aside for municipal issuers. So there are certain pockets, but this is a year where we have to be much more judicious on the security selection. Last year we could have bought pretty much anything with spread on it, and we would have done, and anyone would have done really well. This year it's about finding those individual companies and issuers that can continue to perform in this environment.
Last year was easier. It just didn't feel easy at the time, I guess.
I was going to say that. It didn't feel easy, but
Absolutely
looking back.
Not. Lisa Hornby of Schroders, it's always that line, Tom, that we always go, the easy money's been made. It just never feels easy when you're trying to make it.
Yeah, well, the easy money's been made, but we're seeing that, as we saw with Mike Wilson, this distinction, folks, of alpha and beta, which is equity speak, away from Ms. Hornby. But, John, it's an important idea where you're all in, all boats rising, versus beta, versus the benchmark, you do great, versus going out and finding the individual stories, the individual sectors.
If you're just tuning in, it's a really interesting morning to kick off the trading week. So we have bond yields higher by 3 basis points on 10s to about 137. We were a little bit higher than that a bit earlier in the session. We've seen the equity market gap lower off the back of that. Real yields just starting to break out a little bit. Now, granted, in isolation at negative 80 basis points, historically exceptionally low. But it's about the rate of change, Tom. It's about the move. And the move has been this incremental push higher in real yields.
It's been incremental. And, the Kit Jukes note from SocGen I thought was very smart. Chris Verone publishes moments ago, and he links it directly to the good news on the vaccination. He says bond markets voting that COVID is over.
Can I just note, though, that there's a sort of tenuous balance right now, that everyone is betting that inflation isn't going to pick up too much, and that there's going to be a self-correction within the bond yields to keep risk assets continuing to float upwards. And that's the key question, inflation. At what point does inflation call the hands of the Fed and change this whole dynamic? And John, that I don't think anyone knows the answer, and it feels like we are entering into a new cycle.
But I think we can identify where the inflation needs to come from. It needs to come from the labour market. It needs to come from a much, much tighter labour market, and we don't have that right now.
It depends where. You are seeing a tighter labour market in specific pockets, like manufacturing, goods, transportation, the idea of trying to pack your boxes for Amazon. The question is, when services come back online, if there are fewer restaurants, are they going to have to pay more in order to attract employees? These are some of the thoughts.
Let's hope they do.
Yeah.
Let's hope they do. Let's hope we get away from that business of where we need to tip to pay, and restaurants are in a position where they can
you're going to slip that in as the music goes on.
Well, just, just comparing and contrasting what happens in other parts of the world. Those people work really hard. They deserve to be paid well. In the equity market, down 1.4% on the NASDAQ.
Go to cash.
Let's talk about big tech a little bit later. A little bit later on this program, Greg Valliere of AGF on Washington, D.C., fiscal stimulus and this bond market. This is Bloomberg.
In New York, with the First Word News, I'm Karina Mitchell. Democrats begin the final push for President Biden's $1.9 trillion stimulus bill this week. All the talk of bipartisanship has now gone out of the window. Democrats want to get the measure passed quickly before an earlier round of benefits runs out. The House plans a vote on Friday. The real action will be in private talks in the Senate. There are some Democrats are opposed to plans for a $15 an hour minimum wage. Meanwhile, a study from Israel shows the Pfizer-BioNTech vaccine appeared to stop the vast majority of recipients in Israel from becoming infected. It's the first real-world indication that immunization can stop the spread of the coronavirus. A draft of the study says the vaccine is 89% effective. Some scientists are disputing its accuracy. Meanwhile, airlines have grounded dozens of older versions of the Boeing 777 following an explosive engine failure over the weekend. A United Airlines flight made an emergency landing in Denver after one of its Pratt & Whitney engines suffered fan blade failure. Engine parts were scattered along the plane's flight path. United is inspecting 24 of its planes. Airlines in Japan and South Korea are doing the same. And another takeover in the regional bank business. M&T Bank has agreed to buy People's United in an all-stock deal valued at $7.6 billion. The combined company will have about $200 billion in assets and more than 1,100 branches in 12 states from Maine to Virginia. There have been a number of recent deals among regional banks. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Karina Mitchell. This is Bloomberg.
women leaders were actually better at controlling the deaths from COVID-19. Do you think out of this pandemic, we'll see more countries be willing to elect female leaders?
When we look at women leaders, we tend to project on them baggage that they shouldn't bear.
Women are given an opportunity when no one else wants to do the job.
Women had a very clear objective. They wanted to save lives.
The women leaders, if you look at their careers, have also built up a level of trust.
In fact, women have to be better at communication in order to be elected as leaders, whereas this doesn't hold true for men.
We need to get those sexist stereotypes out of our head and give women a fair run for leadership.
Trying to change the stereotypes about women is not only the business of women, but men have to be part of it.
Why are you running around the world saving the world from hunger? Why are you doing that?
I want to live in a world that I kind of believe everybody's doing as well as my daughters.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Hoping that there'll be a strong recovery. There's every reason to believe we will, especially if Biden's recovery rescue plan gets enacted, and I think almost all the pieces will get enacted, and that's going to provide very strong support for the economy.
This really is the debate of the moment, the size of this fiscal plan down in D.C. That was Joseph Stiglitz there, the Nobel laureate from New York City this morning. Good morning. Alongside Tom Keene, Lisa Bravitz, I'm Jonathan Ferro. Your Monday morning price action looks like this. A bond market that can smell the good news on the COVID side of things, can smell the fiscal stimulus plan down in D.C. It's been smelling it for months. 136 on a 10-year, up 2 basis points. And now we start to bite into risk assets. Down 33 on the S&P, negative 0.89%, adding to the losses from last week. 4-day losing streak. Tom Keene set to become 5 at the opening bell. Yeah. 1 hour, 12 minutes away.
Well, dollar churning, I'll call it a little bit weaker dollar, but really nuanced dynamics here on a Monday. And of course, we go up to a wall of Fed speak through the week, which will make for even more sporting data checks to come. Right now in the sport in Washington, Gregory Valliere joins us with AGF Investments. His morning note is must read. We protect the copyright of all our guests. Get it through AGF. Greg Valliere, where are the Senate conservatives? President Trump would have tried to top tick President Biden. If Biden says 1.9 trillion, I'm sure President Trump would have said 2 trillion or 2.1 trillion. What's the state of Senate austerity right now?
Well, I think Biden's going to lose 50 votes in the Senate. That's all the Republicans. I think he'll get 50 Democrats, although that's not certain after what Joe Manchin did to a Biden nomination over the weekend. So it could be a close vote. We'll get the House passing the bill by, I think, this weekend.
Well, you know, by this weekend, I mean, John Farrow, I look at this by this weekend, but I wonder what the makeup of it will be.
Well, that's the question, Greg, so let's build on it. Is it too big? And what are we married to? And what do we let go?
Well, I think 1.9 is pretty generous, and I recommend to you guys and all your listeners a really interesting editorial in the Wall Street Journal this morning talking about how much of this bill could be pork.
I'm shocked.
Maybe 1.5 is enough, do you think? Maybe 1.4 is enough? So there are some things that I think could get a haircut. I'm not sure we're going to get minimum wage. I'm not sure we're going to get a big chunk of money for state and local governments, maybe not for schools. There are areas to cut, as you'll see in that editorial.
Let's build on that then, Greg. The number, what are you actually looking for? Not what you think should happen, what do you think will happen?
I think something pretty close to 1.9 trillion. Maybe there'll be, I wouldn't be shocked if it was 1.7, but it's going to be a very, very big number, and I think it's a major reason why bond yields have gone higher.
Meanwhile, Greg, Paul Krugman said that this support bill, this fiscal stimulus, is not necessarily preclusive of an infrastructure plan later in the year, but rather a precursor to that you have to get this established to get people back to work and expedite the whole process of vaccinations before you can even think about rebuilding. Can you give us a sense of how much that is the accepted narrative in Washington?
Well, it is among the Democrats, Lisa, and the progressives. I think increasingly, though, Republicans are thinking that's too much. If we follow up a $1.9 trillion bill with still another one at $2 trillion on infrastructure, now I realize that's over 10 years, but still, the numbers they're talking about are just astonishing, and I think a lot of Republicans are getting cold feet.
And they're getting cold feet because they're worried about having to tax and spend, or are they worried about potentially not looking a certain way to their constituents? In other words, how much is actually furthering their own particular interests versus just the headline sticker?
Well, that's a fair point. I think they want to obstruct, and they're not crazy about a bill that big, but they have plenty of cover from Larry Summers. I mean, Lawrence Summers said 2 or 3 weeks ago that 1.9 trillion is too much, and a lot of Republicans agree with him.
But Mervyn King talks, the former governor of the Bank of England, about putting it to work. Greg, do you perceive that 1.x trillion, and I'm going to again mention 2.1 trillion as a top tick, do you perceive it going to investable use, or is it, as you mentioned, all pork?
No, I wouldn't say it's all pork. I'd say maybe a third of it you could scratch your head and say is not totally necessary. But with a number like that, I do worry that you could have an economy that by the fall could look like it's overheating.
Greg, there's one question I think a lot of people have on their mind at the moment. If we do go ahead with 1.9 trillion, you anticipate we will. Does it suck all the oxygen out of the room to do anything else? Can we continue putting programs through the door, infrastructure, and all the rest of it? Do you think we can?
That's going to be a lot tougher, and I think that the Manchin statement over the weekend was really crucial. He's made it clear that he is not a vote that you can count on, and I'm not sure he'd go along with another big infrastructure bill after this one.
And that's the worry. Greg, great to catch up, sir. Greg Valliere, AGF Investments Chief US Policy Strategist. And that's the conversation we had with Kevin Cirilli earlier on in the program, Tom. The middle ground, the moderates, that have some of the control here to shift the debate one way or the other.
To me, John, the question is the so what, and this is immense so what for investors, whether in bonds or in equities. The scale, the magnitude of where we are, granted a natural disaster of a pandemic, whatever your politics, the scale of where we are, it's almost impossible to measure.
Well, I think you've got to put two things together this morning, though, Tom, with this bond market move, and one to build on the words of Chris Verone earlier this morning. You've got the issue around the fiscal stimulus program, yields higher. Then, Lisa, the really encouraging news over the weekend on the pandemic, the cases, the deaths, and the outlook gets brighter after the study that's taken place in Israel.
And it also shows how people have been insufficiently extrapolating out strength. And we have seen that again and again with economists revising rapidly upward their growth expectations as we do get better than expected vaccination news and as we do get this fiscal support. The idea that Greg was talking about of overheating, what does that look like? Are we going to be set on a new
6% GDP?
Well, and does this set us on a new economic trajectory by the end of the year? What does that look like? Does that force the Fed's hand in a new way that we are not necessarily?
I just think this pendulum, sorry, Lisa, has just swung from one extreme to the other far too quickly. In December, we had a negative payrolls print, and there was a massive worry about the labour market, and now there's a worry about the economy overheating. This is exactly the policy prescription that people at the Fed wanted to see. This is what they wanted to see. They wanted to see major fiscal stimulus. They wanted to see major fiscal aid. They don't want to do all the hard work themselves. This is what they want to see. They want to run this hot. They've been talking about this for years. Chair Yellen identified it several years ago, never followed through.
But the issue here is that people have been conditioned to not see inflation. And Tom, you have seen this, that basically they've gotten it wrong time and time again, that they haven't gotten the inflation. They think this time will be exactly the same. That's why the Fed will look through it.
The inflationists have been wrong for a decade. I mean, you can measure it any way you want. John, to me, the idea is the uncertainty that's out there, which leads to the good conversations on our simulcast. There's massive uncertainty out there, 3 months, in 7 months, 8 months forward.
The bias right now, though, is a better 6 months ahead, a better 9 months ahead.
Well, there's no question about that. There's been a massive shift in that. No, you can feel it. Up by Mount Sinai, John, you can feel it on the street.
Things getting better. Your equity market drifting lower, though. Why? Comes from the bond market. Yields are higher on 10s by about 2 basis points now to 135. And the equity market down 31, down 0.8% to 38.7150. Coming up on the program, Megan Green, Harvard Kennedy Senior Fellow from New York City this morning. Good morning to you all. This is Bloomberg.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
This is the 1980s all over again, to make sure that we keep our hands firmly on the driving wheel.
I do not see demand coming back to the pre-COVID level anywhere earlier than the end of 2022.
If that happens and we see a demand recovery, then I think the market can absorb it.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
From New York
City. This is Bloomberg Surveillance for our audience worldwide, live on TV and radio. A really interesting morning, a nuanced morning, but a really simple story to tell. Equities are lower. We're down by about 0.8%. But where's your underperformance? Your underperformance is in the NASDAQ, off by 1.4%. The Y is in the bond market. Let's get to the bond market. 2s, 10s, 30s. Yields up, yields up, yields up. On a 10-year by about 2 basis points. Off the highs of the session, but 135.51 is where we sit. Real yields the story here. Real yields are picking up just a little bit, and they're starting to bite into the valuation story. The story, though, is that things get better in the future. Now, you can pick a couple of things to look at this. Something growthy with something defensive. Aussie yen is an example of that. A currency pair which has moved 13% in the Aussie's favour since the end of October. Here's another way of looking at it. Switch up the board and finish on this. Something defensive against something growthy. Copper, gold. The copper-gold ratio, Tom, has gone vertical. It has gone vertical in the last couple of weeks, and that's something to keep an eye on.
John, what's so important about that ratio, as I can tell from the symbol, that's based off Chicago copper. If that was a London copper to gold ratio, it'd be a different ratio, wouldn't it?
Tom, I did that just for you. Okay, let's leave that there. It's all yours.
Well done. There we are. It's a little confusing. You know, and as I said last week, folks, full disclosure on radio and TV, I'm in John's camp on this, on the predominance of London here within our history of commodities as well. But Chicago's what we look at so much here across America this morning. You know, Lisa, I want to go back. Dr. O'Larian emailed in, and he was all pumped up. He's out at Queen's College in Cambridge, and he's trying to come up with women's ice hockey for the University of Cambridge. And you and I are all wrapped up in Woolman Rink and the Trump Rink and the debate here in Central Park. He's got a prospect here.
Look, we were mentioning this, and we didn't go through on what we were actually talking about. Basically, there are 2 ice rinks in Central Park that are a mainstay for people in a pandemic with children looking to get out. And Mayor de Blasio had talked about shutting them early due to a dispute over the contract that had Trump's name on it. He decided he was overruled after a petition went out. But I will just say over the weekend, it was a point of heated debate among all of the parents of New York City kids who have found that as a respite amid the pandemic.
Huge debate. Lisa's living this right now. The image that you just saw on Bloomberg Radio is afterthought. You could see the fierceness there as she was trying to get to her $30 breakfast snack at the Trump food bar.
How do you really feel, Tom?
Oh, come on. Mr. Trump said that's how they're paying for the rink. You think? Megan Green joins us right now, Harvard Kennedy School senior fellow. Megan, there's all this debate about economics, and we all toss around ratios like productivity, a 3 ratio, 6 unit idea, and then there's this strange thing, the output gap. Do we really have knowledge of where these relationships are, these ratios, given the pandemic?
Well, look, we never really know where the output gap is because it's predicated on this idea of potential growth. And measuring potential growth is much more of an art than a science at the best of times, let alone in a crisis. But I would also argue that this idea of potential growth, this equilibrium that the economy is naturally going to come back to, might be a bit antiquated. I mean, in economics, we believe in equilibria. Usually there's just one, but we've all spent the past year looking at epidemiological models, and the hard scientists don't view the world this way. They look at the world very differently, thinking, you know what, there is no actual equilibrium that we know about at the beginning. Instead, we're going to look at actors, use agent-based models to see how they respond to things, use machine learning to build models around that, and figure out what the outcome is. And so I think this debate about the output gap based on some kind of equilibrium is probably missing the point. And, you know, we economists, we assume that there are very intelligent actors in a very simple world. And I think scientists have a very different view of the world. They assume they're very simple people in a complex world, and there's a lot that we could probably learn from them in economics.
Okay, well, what's the timeline here? What are we getting wrong right now about the x-axis? We've been talking about this across the simulcast all morning, the guesstimates out to June, the guesstimates out to September. Do you have a belief in the x-axis right now, or is that a mystery as well?
Look, I think everything's a mystery at the moment. This isn't a typical kind of downturn, and it won't be a typical kind of recovery at all. And as I've been saying since the beginning of this virus, the virus is going to dictate everything and will be determining prices and quantities. And so, it's actually the epidemiological data that's much more important than the economic data at the moment.
So, Megan, the reason people were gravitating towards the output gap, they were trying to assess how big this package was down in DC and perhaps whether it was too big. So what's the best way of assessing that? Size, too big, too small?
So I don't think we should think of this package as a stimulus at all. It's unfortunately been deemed that, but I think we should think of it as catastrophe mitigation. And so the point isn't to figure out the size of the hole, to measure how big it is and how much dirt we need to fill it in. The point is to get dirt out to those most vulnerable so that we can protect them. And then in the next stage, think about trying to provide a stimulus so that we can get on our way to recovery. And in this sense, I think the next package is almost the more important one if you want to think about potential growth, or if you want to consider there might be multiple equilibria and we're trying to end up on a better one. The next package, the Build Back Better package, is the one that's going to do that.
So what do you think that package specifically, Megan, should look like?
I think it should be full of public investment. I mean, it doesn't matter if you believe in secular stagnation or not. If you think that we've had low growth, low inflation, low rates for so long because of supply side issues or demand side issues, there's one thing that fixes both of those issues, and that's public investment. So, a massive infrastructure spending program that's green in nature, I think is an absolute no-brainer, and a lot of money should be behind that.
Before we get there, Megan, I'd love your assessment of the efficiency of this $1.9 trillion package. Greg Valliere was talking about that Wall Street Journal op-ed talking about the pork built into this plan. Do you have a sense of whether that's actually the case, or whether there is a sort of sense behind each dollar and sort of a firepower behind it?
So I think there is firepower behind it, purely based on the size. Is every dollar perfectly allocated? Absolutely not. But we've already learned in this crisis and in previous crises that we don't have great tools for ferreting out exactly who needs how much money and getting it to them. And so the idea is you just get out a lot quickly. It's not particularly targeted. It could be more targeted, certainly, and it doesn't include things like automatic stabilizers, which I wish it did, so that you took the politics out of this process a little bit and it was all based on what's actually happening in the economy. But the idea isn't to fill in the hole perfectly. We're clearly overdoing it on filling in the hole, but that's okay, because the point is just to get money to the most vulnerable businesses and individuals.
But Megan, what about people who look at the savings rate, the fact that it's climbed so incredibly high? Yes, this gives people firepower, arguably, when the economy does reopen, but does this indicate to you that people are not going to necessarily get this money out into the economy right away, and that it's not as efficient, and that perhaps the people who are getting it aren't the people who need it the most?
So that's where I think this might be targeted a little better towards those with lower incomes or no incomes, certainly, rather than a check going to everyone, which I wouldn't advise. But that being said, I think that the savings rate is a little bit misleading because it doesn't consider all the forbearance that we have at the moment. And so the savings rate has skyrocketed, so has household debt, actually. And you have to consider that when bills finally come due, which many of them aren't because of forbearance, a lot of the savings are going to have to be plowed into that.
Megan, part of your charm is folding politics into your economics. Mitch Rochelle was on Friday from Florida, where houses are being sold in 12 minutes. I mean, clearly the benefits are being skewed across different income levels. Do you have any confidence at all that Washington has a political will to actually get money to those that really need it?
So I think, from a macro sense, absolutely. If you just look at who the administration has hired on the domestic side, it's a load of labor economists, and that's because there is a real concern about income and wealth inequality in the U.S. So I do think, in a big sense, the Biden administration does want to do something about this. But as I said, we don't have great tools for figuring out how to get money specifically to those who need it the most. And What you mentioned in the housing market, I mean, that's clearly a result of central bank policy. That's the Fed. Mortgages, cars, those markets have been on fire because rates are so incredibly low. And, you know, I think they will be for a very long time. So I think we can continue to see those markets do well.
Megan, good to hear from you. Thanks for joining us this Monday morning. Megan Green there, of the Harvard Kennedy School Senior Fellow. I want to pick up on just one point that Megan made there, and it's an important one that Lisa actually made several weeks back. The savings rate has exploded, but so's the level of debt, and so has forbearance as well. And Lisa, I think that's important. There are some debts that haven't been paid, that will need to be paid, and it's going to be interesting to see the proportion of that savings that has been put to one side that gets used to re-engage with the economy and what gets used to pay off the debt.
Why can't they use 1.x trillion to help with the rents, to help with the mortgage payments of the landlords who've been absolutely crushed?
Well, this is a good question, and I'm going to put the politics aside. But speaking, John, to your point, the idea of people saving all of this money to pay back the debt that's accumulated, this is what Jared Bernstein, economic advisor to President Biden, said when he came on this show, that perhaps we're overestimating the savings. How much are we then overestimating the boom in spending on the other side, right? Because how much of the savings actually goes into discretionary spending, and how much is sort of pent-up repayment to all of those debts that have built up, John? I think this is an important point. How much does this remove some of the dynamism and go instead into just simply maintaining the status quo?
So we've got to put you on a spot here, Lisa. We're going to get the inflation, or aren't we? You know, you've got to try and reconcile these two views.
That's
with the labour market and with spending.
Well, this is the big debate, and people don't necessarily know how this is going to play out, and they don't have a sense of how much the economy is accelerating.
We'll have that conversation on Bloomberg Television in the next hour.
We're trying. Oh, here we
go. With Ashok Bhatia of Neuberger Berman, Matt Miskin of John Hancock as well, Brian Belsky of BMO, together with Stuart Kaiser of UBS. Quite a lineup in the next hour. If you want to drop by and tune in.
Maybe I'll stop by and check it out.
That would be awesome.
That'd be good.
might let you come upset. You do have a show on Bloomberg Radio you might have to anchor, Tom, but if you find the time to come over to TV, you're more than welcome.
You know, we got the Zamboni driver over at Woolman Rink.
He's going to drive you over to the set.
From New York City this morning, good morning. Welcome back after the weekend. Really interesting week coming up here with Fed Speak on deck with Chairman Powell just around the corner tomorrow. Alongside Tom Keene, Lisa Abramowitz, I'm Jonathan Ferro. Equities off the lows of the session, bond yields off the highs of the session. Up just a basis point now on 10s and down just 27 on the S&P, negative 0.7%. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. The U.S. and Iran are sparring over how to revive that nuclear deal. Over the weekend, Tehran renewed its demand that the Biden administration rejoin the accord and lift sanctions before talks can resume. The U.S. response is that Iran is isolated diplomatically, and the ball is in their court. Meanwhile, the next phase of President Biden's legislative agenda is taking shape. It's an economic package that will be potentially much larger than the $1.9 trillion virus relief bill that's now before Congress. The centerpiece could be the biggest infrastructure spending commitment since the New Deal. It all may be unveiled next month. Meanwhile, in the first real-world indication that vaccination will curb the spread of the coronavirus, a study shows that the Pfizer and BioNTech vaccine appeared to stop the vast majority of recipients in Israel from becoming infected. The vaccine was 89% effective in preventing laboratory-confirmed infections. And in the UK today, Prime Minister Boris Johnson will announce that all schools in England will reopen starting March 8th. Johnson will be in Parliament outlining how the coronavirus lockdown will be lifted over the next few months. More social contact will be allowed from March 29th. That includes outdoor gatherings of either 6 people or 2 households. And shares of Petrobras plunged as much as 16% in Sao Paulo today. Brazil's President Jair Bolsonaro replaced the head of the country's state-controlled oil company. The move shows a president impatient with the government's inability to appease his political base. Truck drivers have been threatening a strike over rising diesel costs. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Texans who have suffered through days of freezing cold without power should not be subjected to skyrocketing energy bills due to a spike in the energy market. So I held an emergency meeting yesterday with legislative leaders to begin the legislative process to shield Texas families from unreasonable bills.
The governor of Texas, a beleaguered governor of Texas, and it is good news about Texas right now, and of course all of the Midwest, warmer weather, and even the idea of from electricity to the freeing up of urgent need for water. So all in all, Lisa Abramowitz, it's been good news, hasn't it?
After a pretty dire spate, I mean, this idea that this unusual weather pattern might not be so unusual going forward, Tom.
The heritage of what we do here, from Bloomberg on the economy to Bloomberg surveillance, is to get away from the hype and the hyperbole, and yes, politicians managing their message, and actually talk to the adults in the room. On the grid, nationwide, she is the adult. She is with James Baker at the Rice University Center for Energy Studies. Her book, The Grid, with MIT Press, is the Bible. It is the definitive book on what we have wrought. Professor Cohn, thank you so much for joining us. Just thrilled to have you with us here on radio and TV nationwide. Can Texas become more like the other states, the other regions?
That's an interesting question. We could, of course, become more like the rest of the country by interconnecting with the Eastern Interconnection or the Western Interconnection. We could become like other states by restructuring how we trade wholesale and retail power. And we could become more like northern states by winterizing our electrical system and also our natural gas system.
It happens by crisis. I happen to remember crystal clear that great blackout of the 60s where life changed on the East Coast. We've had another blackout-like occurrence. What legislation will you look for? What action will you look for to say not only Texas, but the entire nation has changed its tune?
Well, Texas is heading into a couple of weeks of hearings at the state legislature on that point, and I think the big questions will be, do we need to build into our market ways to incentivize investment in winterization, ways to look at interconnecting east or west, and I'd love to come back to that point in a moment. And I hope, although I haven't heard people talking about it, but ways to protect the public in the event that there are these kinds of emergencies again. One of the characteristics of large and complex technological systems is they might fail, and we need other ways to think about how do we protect the public? What do we do to make sure that if that happens, there are backup plans in place?
Connecting the grid. Texas has intentionally isolated its grid from the rest of the nations. Can you talk about why it has done that, the logic behind that, and how that played out in this circumstance?
It's a long history. It dates back to 1935 when Congress gave the Federal Power Commission the authority to regulate interstate wholesale power sales. And the Texas utilities preferred not to fall under that regulation and formed an agreement to not interconnect across state lines. And I don't believe they were isolated in the sense that they were the only utilities avoiding federal regulation. I looked at a map this morning, and there were other states that in which the utilities did not interconnect for some decades in the 20th century. But for Texas, that it wasn't a problem. The reasons companies interconnect are to gain access to bigger markets, to reach distant power resources like falling water, and to provide backup power to each other. And within Texas, the utilities were able to do that without crossing state lines because it's a big state. And beyond that, I lost my train of thought.
Well, no, I mean, there also was...
That's okay. Julie, it's surveillance. You're allowed to lose your chain of thought.
And then just make it up. That's what we do.
Save Professor Cohn right now, Lisa.
Well, no, I mean, honestly, then it goes to the whole idea of competitive bidding on certain energy, and that also allowed for certain innovations. But Julie, going forward, there's a question of whether there should be more national control, not necessarily out of necessity, but out of the putting money behind resources, behind the developments of grids that can be more stable and sustainable through all types of weather. I mean, do you see that as the way forward, that there needs to be a national sort of hand in this?
It looks to me like there are multiple paths going forward. One would be bigger and stronger transmission links across the country, and that could benefit utility-scale renewables like wind power. Another might be distributed energy systems that provide redundancy and resilience when there are outages. So a little neighborhood has its own smart grid, and if the big grid goes down, the little neighborhood can disconnect and run a generator and keep power on. And whether or not that becomes a federal role is, it would be unusual in American history, but it could be a solution. It may not be a palatable solution.
Professor Cohn, thank you so much. Greatly appreciated. Julie Cohn, she is the nation's expert at the Baker Institute in Texas. Yes, on Texas in the grid, but I can't say enough. Her one volume, MIT Press, The Grid, it is the definitive source on what we've all observed here over the last number of weeks. Thrilled to have her on our simulcast today. You know, Lisa, it's about it, and we move on, and you just wonder what the political follow-through will be in Texas and, frankly, nationwide.
Well, initially, it was interesting to hear the regulators really paint this as a problem of diverting too much money to solar energy, or not solar, but also wind powers, the wind turbines, with the images of the frozen wind turbines. And that's shifted. That was a small fraction of the overall power. It clearly was more widespread and had a more complicated backdrop. But this really does fuel Biden's whole push to upgrade the infrastructure of this sort of grid. You have to wonder, how much support will there be after this kind of incident?
Major shout out to Matthew Winkler, our emeritus editor-in-chief, who nailed this, in that Texas has led the nation in renewable energy, renewable power, and all that. What I know is everybody's got a political angle, Lisa, and you got to go to people like Professor Cohn to actually find out what's going on. Lisa, what do you see in the market? I see a VIX at 24. That gets my attention.
And I see yield curve widening out, at least if you look at the 530s, to the highest since 2014. The reflation trade very much in front and center. What I think is interesting is it's working like clockwork. Yields go up to a certain point, stocks go down. At what point does that get the attention of the Fed? At what point does that get the attention of investors to either buy the dip or sell because there's something material changing.
Yeah, I'm not going to get into buy the dip or, all the different when do you get in.
Go to cash, right, Tom?
No, the punditry is healthy. I mean, there's a lot of different opinions out there. Lisa, I've got to go to what we saw today, which is the M&T Bank merger up in Buffalo with People's United. Deals are getting done away from all the hysteria.
Well, and you said something that I thought was really profound, this idea of...
Can I go home for the rest of the week?
Sure. Yeah, take a drink and go home. But I said the nimbleness of being big, that there is a certain nimbleness of being large because you have to merge and consolidate at this moment.
And that's true of Phil Curray 101, the legendary investor and pioneer. It is without the bright lights of inflation. You've got to be nimble. Balance of power on radio and television. The gentlelady from Florida, Stephanie Murphy with David Weston. Stay with us. This is Bloomberg. Good morning.
It's extremely exciting for the university, for being a historically black college and university. It's just exciting for our engineers to actually be allowed to work for a large firm such as Boeing with such technologies that we can see the outcome.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. From New York City for our audience worldwide, good morning, good morning. The countdown to the opening bell starts right now. 30 minutes away from the open, we're off the lows. We're down 26 on the S&P, and Treasury yields are off the highs. We begin with the big issue. Treasury yields breaking out, equities breaking down.
Clearly, markets down today.
It makes sense that yields are rising.
U.S. Treasury yields now trading, close to 140.
Rates have basically doubled in the past 4 months.
There have been some rotations under the surface that have been driven by this increase.
All markets, as you've been talking about, are pointing towards reflation.
The direction of travel is gradually higher yields.
Start worrying when real yields start to rise.
The negative real yields are telling you that there's weakness out there.
If you look at real yields,
you're starting to see real yields move from below negative 1%.
Real yields are rising.
Short term, we've seen a very, very sharp move.
I don't think this is cause for concern so far.
People are thinking that interest rates will stay very low.
The first hike is still way off.
That's essentially what's sustaining stock markets.
Let's bring in the Bloomberg team, Kaylee Lyons and Michael McKee. Good morning, Kaylee.
Morning, John. Well, the reflation trade is roaring ahead, but equities not roaring ahead, at least this morning. Futures pointing to a negative open, and at least part of that story does have to do with those higher bond yields. The reflation trade leading to a steep sell-off in the bond market, particularly in duration. The 10-year yield, granted, well off session highs, but still sitting around 1.34% after climbing about 7 basis points over the last 3 sessions. And with that selling in the longer end of the curve, the bear steepening has been the story. Earlier this morning, the 5/30s curve, very closely watched, hit the steepest since 2014. That has come into touch, but still sitting right around 154 basis points. All of that on the reflation narrative, hopes for fiscal stimulus and better economic growth. And that is feeding into the commodity complex as well. You have oil higher this morning, up about above $60 a barrel once again for WTI. Brent holding above $63. Goldman Sachs saying it could go up to $75 by the end of the third quarter, thanks to the supply and demand dynamics. And those supply and demand dynamics are factoring into copper as well, above $9,000 a ton in the London trade. That is the highest since all the way back in 2011. The thinking there is demand is going to build as global growth improves, and supply, potentially, you could see a shortfall. And it's not just copper, it's really the entire industrials metals complex that is rallying this morning, John. And finally, I also have to touch on Bitcoin. You can't do a market check without talking about it these days. It nearly climbed to $59,000 over the weekend. Right now, it is on pace for its worst day in about a month, back below around 52,000. Some concern that this asset has gotten overheated. Even Elon Musk said that the prices look a bit high. And my answer to that is, well, yeah, you are looking at a 52 handle still on the cryptocurrency, John, up 65% over the course of February thus far, John.
We might touch on that a little bit more a little bit later, Kelly. Thank you very much. We've got to turn to the Federal Reserve. Yields breaking out, and it's not inflation expectations in the last week. It's real yields. We've got Chairman Powell just around the corner. Here's Mike McKee.
John, Jay Powell is not going to back down, not going to change his mind on the path of rates, not even going to hint at any change in the path of rates. And why should he? Yes, yields are higher across the board from the belly on up. And Kaylee pointed out that we're near some highs. But what's that doing? Pulling forward Fed funds futures and the estimates for interest rates? Well, sure, but look at the numbers. We're looking at 9% chance by January of next year. That is not a whole lot. And when Powell looks at the markets this morning, here's what he sees. Rates are higher. The 10-year note yield is up off its highs, but it is up. And then the market's assessment at the same time of inflation break-evens has fallen. So we're not really looking at a problem in terms of what the market is seeing at the moment. And then you look at financial conditions. They've come up a little bit over the past few days, but the financial conditions index is still very, very low. So you can expect the chairman to stick to his story that we are a long way from their targets for employment and inflation, and they don't need to think about making changes. There's that chart that I was talking about there, and you can see how inflation expectations have dropped. What might make news? Well, Powell's definitely going to be dragged into the debate over the Biden economic rescue plan. Democrats will want him to repeat that additional stimulus is necessary for the economy to help people out. Republicans may show up with cardboard cutouts of Larry Summers and say, yes, but even your guy says this package is too big. Odds are he'll try to avoid taking a direct position on that, stick to his lane, tell Congress it's up to them to decide what goes into the package. We're a long way from a jump in inflation. And John, you mentioned this earlier this morning, how we're not seeing wage pressures. Yes, you'll see some temporary spikes in commodities, but labor market slack. The white line there is the manufacturing output in the economy gone way up, but labor market jobs, manufacturing jobs jobs have not kept pace. An argument made by Geeta Gopinath, the IMF chief economist, this weekend. So it looks like at this point the Fed is going to be able to stick to its guns and stay out of the way.
Are you suggesting that a cardboard cutout of Larry Summers scares Democrats more than Republicans these days, Mike?
It seems to, yes. That seems to be the dialogue that's going on right now. Larry is the boogeyman for Democratic priorities.
There you go. Mike McKee, much more from Mike through the week. Chairman Powell tomorrow, then Vice Chair Clarida will catch up with Governor Brainerd through the week as well. On the Fed speak, on the Fed, Neuberger Berman expected inflation to keep rising in the months ahead and writing the following: when the Fed finally responds to the new inflation dynamic, we believe it'll do so more aggressively than markets anticipate. We favor inflation-protected securities with an underweight view on duration exposures as we move deeper into the year. Ashok Bhatia of Neuberger Berman joins us right now. Ashok, let's just start there. The Fed has said repeatedly, Chairman Powell has said repeatedly, that monetary policy is in a good place. Do you expect to hear the same thing tomorrow?
Yeah, absolutely. I think echo what Michael McKee just said. I don't think there's going to be any change to what Powell has to say. Fed's on hold. Fed's not going anywhere, and they're not even thinking about interest rates. So the Fed is going to be, for the next quarter or two at minimum, a pretty, minimal story, we think, for the markets.
So the front end's anchored. How much freedom does the long end have? 10s, 30s, Ashok?
So thinking the long end, so thinking about the 10-year, we're around 135 this morning. We think somewhere 150 to 175 is where the U.S. bond market will find a little bit more stability. If we had to pick one number, maybe around 165. So, and that's where we think valuation technicals will kind of come together to provide a little deeper support for bonds. So that's another meaningful move higher in rates from these levels.
Could you give us some more color there, Ashok? Why we have this self-limiting dynamic that puts the lid on treasuries at around 150?
Well, I think, it kind of comes back to why have risk markets started to get a little softer in this rise in interest rates over the last couple of weeks? And I think there's a couple of components. There's really three. One, as some of your guests have spoken about, this rise in rates has a higher percentage of it coming from real yields. Second, it's more global in nature. So in the last couple of weeks, German bunds, as an example, have started to participate in the rise in interest rates. And third, and perhaps most importantly, we're seeing feedback into the dollar. And, Jonathan, I think you were speaking about this in the previous hour. The dollar's starting to strengthen. And so those three things are giving this rise in rates a little bit more of a negative dynamic for risk markets. And our best estimation is somewhere, with another 30 basis points or a little bit more rise in yields from here. All three of those things kind of continue, and that will provide a bit of support coming from potentially slightly weaker risk assets.
Let's pick up on the FX move in just a moment, Ashok. I want to jump in on something that I know you're thinking about. We're talking about stimulus here and the amount of supply we might get in the debt market. I just wonder, from your perspective, how peculiar it would be for real yields to carry on rising as the debt to GDP ratio grows.
Yeah, I don't think it's certainly not inconceivable. I mean, real yields are deeply negative. Even if we took real yields back to pre-COVID levels, that's another 50 plus basis points real yields could potentially rise. I think the challenge is we all know this is going to be a very strong year for GDP. The outlook and the question on the stimulus is it changing the 2022 to 2023 GDP trajectory where real yields should be higher? And I think that's still enough of an unknown, but we're going to sort that out over the coming quarters.
So this is the analysis. Let's talk about the capital allocation, Ashok. You've given me your view on how the world works right now, how you think it works. Where's the money go?
Well, we think money is going, and the spots we still like, it's kind of a continuation. It's income without duration, so it's a lot of floating rate securities, short duration, high yield, out of investment grade credit into below investment grade. Fundamentals are still very positive for a lot of corporations globally. We think that provides a support for a lot of these credit markets. It's underweight in longer duration. It's overweight to things that can give a portfolio a bit of inflation protection. And I just, real quickly, just remark, we see a lot of, I think, intellectual engagement on the idea that income inequality and inflation rising, that these are durable themes. But I'd say we're just starting to see capital move to really invest on those themes. And that provides a longer runway for some of these ideas to potentially work over the coming quarters.
Do you think it's right to emphasize the short duration trade over pretty much everything at the moment? Ashok, I've been catching up with some of your peers more recently, and credit risk just doesn't seem to be a factor right now. It just seems to be about rate sensitivity, duration risk.
Yeah, I think it depends, just real quickly, if you're need long duration, investment grade credit's still a good place to be. Spreads we think are going to remain pretty low and pretty tight. if you're thinking about fixed income more from a total return perspective, yeah, we do think some of these shorter maturity securities where you have less risk of total returns given, rates potentially going up, we still think that's the place to be. Unless we see a change in fundamentals on the corporate side, corporate credit markets can have a little bit of a, sell-off, but we think it's going to be pretty contained.
Pretty contained through last week. High yield spread still in and around 320. Ashok, stick with us. We need to talk about the global bond market as well. Ashok Bhatia will be alongside us in just a moment. I want to get to the broader market. We're down 27 on the S&P, in and around negative 0.7%. The bond market behaving. Yields were really flying a little bit earlier. We settled down just a bit. Let's get you some movers at the market desk. Here's Kriti Gupta.
Well, good morning, John. A good chunk of the price action stock showing up in the aerospace sector after a Boeing 777 flight showered debris near Denver. A scary story that's showing up in the price action right off the bat. Boeing shares under pressure, and that's a sentiment that's rippling through the supply chain. Raytheon Technologies down 2.5%. They're the ones that manufacture that engine. And Spirit AeroSystems, which is also a major Boeing supplier, taking a little bit of a hit today. Flip up the boards, and I'm actually going to start from the bottom up. United Airlines actually up on the day. It was down in the pre-market. That Boeing 777 flight, lots of sevens there, was actually United Airlines flight. They halted after Japan and South Korea also halted their flights. Moving upwards, you see American Airlines and Delta Airlines upgraded in line with 8 other airlines out of Deutsche Bank, citing that vaccine news. Pfizer taking a little bit of a pullback, even though they had some really great news over the weekend. Pfizer was shown to be very effective in terms of curbing the transmission rate and curbing, of course, the effectiveness against other COVID variants around the world. So that also helping the airlines and taking a little bit of a hit on Pfizer, but who knows, that could always change throughout the day, John.
Kriti, thank you. If you're wondering what success looks like down in Washington, D.C., Secretary Yellen is speaking at a conference at the moment. She said success would be a return to pre-pandemic employment. And to pick up the number that Chairman Powell used in a speech just a couple of weeks ago, 10 million fewer people employed now versus 12 months ago. I imagine that number has moved a little bit since then, but that's success in the minds of the administration and Secretary Yellen. Success would be a return to pre-pandemic employment. Coming up, the outlook for the pandemic improving amid declining hospitalizations and more positive vaccine news. That conversation up next with John Hancock's Matt Miskin and Ashok Bhatia of Neuberger Berman. 18 minutes away from the opening bell this morning. Good morning to you all. Equity futures down 29, down 0.75%. This is Bloomberg.
very good chance to not only have positive growth, but perhaps a somewhat more encouraging positive growth.
The rebound in the second and third quarter will be quite strong because the expectation is that the vaccine will help clear the way to less restrictive lockdown.
We are going to have a recovery, but it's going to be an uneven recovery.
Of course, it will have direct impact on our growth forecast, and it will be very difficult to reach 6% of growth.
You're going to get a roaring 20s type of recovery and a boom period.
We are certainly seeing ourselves towards the second quarter being in almost opening the economy as much as one can.
We should not be too quick to cut back on the expansionary fiscal policy.
We'll get there. The question is not a question of if, it's a question of more when.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It's stunning when you look at the numbers.
almost unbelievable, but it's true. This is a devastating pandemic, and it's historic. People will be talking about this decades and decades and decades from now.
Amid the shocking numbers and dire warnings, the outlook for the pandemic continuing to improve. The Johns Hopkins School of Medicine seeing the potential for U.S. herd immunity by April, writing in an op-ed for the Wall Street Journal, quote, as more people have been infected, there are fewer Americans left to be infected. At the current trajectory, I expect COVID will be mostly gone by April, allowing Americans to resume normal life. This coming together with positive news out of Israel, a new study showing the Pfizer-BioNTech vaccine stopping the majority of recipients from becoming infected. On the latest, on a better outlook, is Katie Lyons.
Well, John, of course, Israel is leading the world when it comes to the vaccination effort and seeing some pretty encouraging results. The country has said that the shots prevent 99% of COVID-19 related deaths, and they also appear to stop patients from spreading the virus. According to an Israeli study, the shot was 89.4% effective at preventing laboratory-confirmed infections. Those results have yet to be confirmed, but if they are, it signals the vaccine may prevent asymptomatic carriers from spreading the virus. Now, as I said, Israel is really out front in the rankings when it comes to the vaccine rollout. It's given about 79 doses per 100 people, so the majority of adults in the country have already gotten one. Following Israel is the Seychelles and the UAE, and then the UK, of course, has been hailed for its effort. It's vaccinated about 27 per 100 people. Here in the US, that number is only 19 per 100. Of course, the effort was disrupted by last week's deep freeze, but it is set to pick up steam in the coming weeks. And there are encouraging signs not just on the vaccine trajectory, but on the virus trajectory as well. Cases coming sharply down across the country, the hospitalization rate hitting the lowest since early November, and the pace of fatalities is slowing, though of course we are still set to pass that 500,000 death threshold this week. As for that herd immunity story, that Wall Street Journal op-ed you just cited at the top there, I was speaking to one physician this morning who said that may be a bit overly optimistic, that April for herd immunity might not be realistic. So there may be some debate about the timing, John, but one can see the signs for optimism here, John.
Fueling optimism. Kelly Lyons, thank you very much. Where should it fuel optimism a little bit more so, though? And I think this is the dynamic in markets we need to discuss a little bit more. The United States is flying. You add in the fiscal stimulus to that, you can see why Treasury yields are higher. But that move in Treasury yields has lifted bond yields as well. It's lifted global rates. And I think what Eric Nielsen over the weekend talked about with UniCredit is really important. Are we starting to see an unwarranted tightening of financial conditions outside of America, in Europe specifically? He goes on to write the following: it'll leave the ECB no choice but to step up their purchases to counter the undesirable tightening of monetary conditions. Nielsen also saying he'd be surprised if we didn't hear the first warning shots within the next few weeks. Well, we hear from Christine Lagarde, the ECB president, I think in the next 15 minutes. Let's bring in a team, shall we? Matt Miskin of John Hancock, Ashok Bhatia of Neuberger Berman, still with us. Matt, I want to start there. Do you think we're seeing an unwarranted tightening of financial conditions abroad, elsewhere, internationally?
I mean, I think that the ECB is going to need to act and step up to suppress these bond yields. And I think it really actually makes a big difference for the banking sector. And one of the reasons why we're actually modestly underweight Europe in general is financials is the largest sector there. Those negative interest rates are likely to stay in place, and that's going to weigh on those banks to come out of this recession.
Ashok, can you build on that as well, sir? The same question to you, whether you think the ECB is at that point now where maybe things are moving a little bit too quickly for Europe.
Yeah, I suspect that the ECB will start on some, rhetoric around this. From their perspective, this has been a pretty modest rise in bond yields, about 20 basis points. Periphery yields remain pretty well contained or are contained, and the currency hasn't really moved a whole lot. So I think this is where we'll get some verbal, intervention, if you will, but not believing we're going to see a policy move near term.
We came into 21, Ashok, looking for this big global growth dynamic, the story that maybe we saw through much of 17 into early 18. Are you expecting a little bit more dispersion than maybe you thought we would get a couple of months ago?
Yeah, I think if there's a story that's perhaps slightly underappreciated is the strength that we'll see in Asia. China is the one region that we think we will see some rebalancing of financial conditions after extremely easy policies last year. We think that that's something the market can absorb and ultimately, provides a better structural base. But Asian growth, we think is going to be quite strong, and maybe contrast that a little bit with Latin America, where perhaps a little bit more relative weakness given the COVID and vaccine response. But the overall view from us is still this is going to be a pretty strong couple of years of global growth.
Matt, add to that, please, the regional bias at the moment, where it shifts for you off the back of these dynamics.
Well, the China credit index is rolling over. So, that might be all that matters in global markets right now. But that's one of the reasons why we're not chasing this reflation commodity-driven trade. You can't have a commodity supercycle without China. And if China's slowing in terms of their credit impulse, we'd rather play the consumer. We do like China, just a different twist on it versus commodities like they used to trade in the past.
Matt, this is where I struggle as well. We've got this move in real yields. We've also got this move in copper, in the Aussie. All of these growth-centric kind of themes are all playing to the same tune. But when you start to think about real yields in the United States breaking out, I start to think about something Ashok mentioned about 15 minutes ago, which is the dollar bearish trade starting to break down. And there's two things that supported. One's EM, China, and the other story really has been the commodity trade as well. Are you worried about that then, Matt?
I am. Yeah, I mean, we look at this as a dollar weaker risk on trade. And if the dollar does start to strengthen or finding some support here in the first quarter after such a big drawdown, that changes the market, the total complexion of this market rally. And we would trim into strength that commodity complex, redeploy capital on higher quality businesses, high free cash flow, and more in the U.S.
How disruptive would that be, Ashok, if we started to get real yields bite in the FX market just a bit more, bite into that huge short position that developed coming into the new year?
Yeah, I think that is, in our minds, one of the larger risks near term for the markets is just exactly what you said, a little bit more of a move to disorderly or stronger dollar strengthening. Ultimately, I think the real yields globally are going to need to find a base, and once that happens, do think the dollar weakness will resume, but we might be 20, 30 basis points in yields away from that.
Final word to you, Matt. What's the conviction trade right now at the moment?
So emerging markets are top idea, and then playing mid-value within the U.S. Industrials weak today on some of this news. We would look to that as an entry point in the United States and barbell it with EM. Those are top reflation ideas. Then still playing quality across the portfolio for in case this reflation idea and complex does see some choppiness after such a big run.
Well, Matt, I have to say I'm shocked. I'm surprised. You brought up what's happening in China, and then you throw in a long EM trade off the back. Why?
Well, so in our view, China is going to be the complexion of what China has changed dramatically. So it's a consumer-driven economy, technology and consumer discretionary, the largest sectors now. It's a different play than it used to be, where it was just a commodity powerhouse. And so now we're playing that, the consumer and technology. And really, that's where EM is. China's the biggest allocation there. But it's a different way to play it than what it used to be 5-10 years ago.
Matt, good to catch up. Always appreciate your time. Matt Miskin there. And great to catch up with you, Ashok, as well. Thanks for your time. Ashok Bhatia there of Neuberger Berman. Let's get to these markets. This price action. Yields are up just a little bit, up a basis point. Real yields are up as well. And look where it's biting. Get to the equity board. S&P 500 futures down 30, off by 0.8%. But where's your underperformance? It's on the NASDAQ. NASDAQ futures down 190 and off by 1.4%. Up next, the analyst action you need to know. That'll be next in our morning calls. And later, the impact of rising inflation on equity markets. That conversation still ahead with BMO's Brian Belsky and Stuart Kaiser of UBS. From New York, this is Bloomberg.
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
It's 5 minutes away from the opening bell this morning in New York City. Good morning. This Monday morning, futures down 31. We're off by 0.8%. Going into the opening bell on a 4-day losing streak, it could become 5. Let's get you some morning calls. A look at some of the analyst recommendations on Wall Street this morning. We begin first up with Loop Capital upgrading Airbnb to a buy ahead of its earnings report. The analyst expecting results to top expectations after a number of competitors reported their own solid numbers. Your second call from Deutsche Bank upgrading US airliners to a buy. The analyst highlighting the reopening process with infections and hospitalizations trending in the right direction. And the number 3 call of the morning, Morgan Stanley upgrading Snap to overweight, $80 price target. The analyst seeing substantial user growth due to improving advertising products and monetization. That stock is positive 1%. Up next, around the opening bell, taking advantage of rising inflation in the equity markets. That conversation with BMO's Brian Belsky and Stuart Kaiser of UBS. From New York, the cash open. Next, right here on Bloomberg.
These solar arrays that we're going to install are going to be about half the size of the existing solar arrays that we have on the International Space Station. But because of the advances in technology over the years, they're going to provide about twice the power in just half of the area that the existing solar arrays cover.
Let's just start with the numbers.
And it would be essentially free cash flow positive in 2021. That was sooner than people had been expecting.
We have pretty good numbers here in the biggest divisions of Morgan Stanley. They are firing on all cylinders.
We've had this huge rivalry historically between Morgan Stanley and Goldman Sachs.
There are 24 reasons for Mr. Diamond to celebrate today.
As much as people may want to focus on trading, for Bank of America, it's all about credit.
It seems the markets are very happy with Trump. They're very happy with Biden.
Start your mornings with Bloomberg Surveillance. Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Extraordinary market day.
This rally just keeps on going.
But there is a tipping point.
The business team you love to watch. Weekday mornings on Bloomberg Television.
Revenues coming better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
25 seconds away from the opening bell, a 4-day losing streak is about to become 5 on the S&P 500 as we inch towards the open. Equity futures still lower, off by 1.4% on the NASDAQ. That's where the pain is. And here's the why. Switch up the board into the bond market. Treasury yields bleeding higher over the last week. 135 on 10s, up a basis point. Real yields Negative 80 basis points now, up a couple of basis points on a session. Into the FX market, where the euro stays just a little bit firmer. Euro dollar 121.44. But the commodity market is just absolutely flying. WTI up another 2.3%, a 60 handle, 60.60 on crude, and copper north of 9K. We're going back to levels we haven't seen on copper since 2011, a decade ago. That's the cross-asset story at the market desk with your movers. Is Kelly Lyons.
Hey, John, well, we have to kick it off with Boeing this morning. The stock opening lower by more than 2.5% after an engine failure on a 777 jet flying out of Denver over the weekend. No one was injured, but it has led to the grounding of the jet in Japan. The UK suspending all planes that have that same Pratt & Whitney model engine, and the FAA has ordered emergency inspections. Really just the last thing Boeing needed. To the upside, though, Kohl's is moving higher by about 6%. This after reports over the week that a group of activists want to add 9 board members and push the retailer to improve operations. Speaking of activism, Elliott Management reportedly building a position in Principal Financial Group, planning to push for changes at the life insurance company, which is higher by about 7% at the opening bell. And some M&A action on this Monday, too. Goodyear agreeing to buy Cooper Tire for about $2.8 billion, a premium of 24% to its closing price on Friday. The shares higher by about 20% this morning. And if we can switch up the board, take a look at what I would call some frenzy stocks. 2 related to Bitcoin, Riot Blockchain and Marathon Patent, both lower by 13% this morning as Bitcoin heads for its worst day in over a month. Concerns the cryptocurrency maybe just got a little bit overheated. GameStop, though, the poster child for the Reddit retail frenzy, rebounding up 14%, though at $46 a share. It is far, far below that $483 intraday high it hit just a few weeks ago. And finally, John, I just want to point to some of the stocks leading the losses in today's session. You said it is tech bearing the brunt of the burden. Apple